CEO. It's fantastic to have you back on set in San Francisco. It's amazing to see the world change so quickly each quarter. Come back soon. Now, coming up on the program, we're going to sit down with the Lyft CEO, David Risher, as the company holds its first ever Investor Day. And I know so many of you in our audience had a lot of questions for David. We'll put some of them to him next. This is Bloomberg Technology.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your mouth.
Natural gas futures extend gains. Prices at the highest since January this year.
That's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ Monday on Bloomberg.
Lyft has been holding its first ever Investor Day this week, with the company projecting gross bookings to grow about 15% at a compound annual rate over the next 3 years. Investors liking that clarity. Let's dig in a little bit more. The Lyft CEO, David Risher, who's here in New York City. It was a big event.
It was.
Lots of musical performances, and then the serious matter of numbers, of margin. What gets you that 15% compound increase? What gets you an improvement in margin and profitability too?
So I don't think you're going to be surprised about this, but the answer is customer obsession is what gets us there, right? I mean, we're a scale business. We're a scale business. We do 2 million rides a day today. We're going to get to $25 billion in bookings over the next couple of years. That just means doing more of what customers like, picking them up faster, pricing better, and then innovating, like with Women Plus Connect and some of the other things we've talked about before. It's really the basics, but you do them really well over and over again, and you can grow an incredibly big and profitable business.
I can see that helping bookings. How does it do the profitability? Do you have to start to charge people a little bit more to be able to get that margin?
No. In fact, that's not at all in the plan. Instead, what is in the plan are things like Lyft Media. So this is such an interesting thing. Think about all the different ways brands want to talk to you today. A lot of them are online, right? They're through Google, maybe Meta, whatever it is. Well, we actually have people in cars going to grocery stores. And is that interesting that maybe, Crest versus Colgate, maybe you don't care too much, but maybe there's an advertiser who'd like to talk to you right as you're about to walk into Kroger, for example. So that's part of the way that we can kind of work with margins. We can also work with modes and some other things. A lot of good ideas there.
David, good morning. It's Ed. I'd like to look past the numbers a little bit. I understand the 709 million rides you did in 2023. And you make this argument that your target market or total addressable market is based on the total miles driven in personal cars. But what I don't see is how you're going to go after that addressable market, convincing people not to use their own vehicles, but take you instead.
Right. Well, I don't have to do a lot of that, to be honest. It's 160 billion trips that people take a year. Let's just look at the daily commute. Every single year, people commute to and from work 55 billion times. 55 soul-crushing billion times. So you don't have to take much of that to make a real difference in our 700 to 800 million rides. We've got a new product that we're just in the process of developing, for example, that will allow you to lock in your price. So every single day, instead of a price that bounces around, you get a consistent price. And that's something we know people stress about. Literally, people wake up early in the morning just to check a couple of different apps to figure out what the least expensive way to get to work is. So if we can take that off the table, that might increase us by, call it a ride a week. But a ride a week times 52 weeks a year times millions of people, it adds up pretty fast.
David, when I said you were coming on the show, the majority of questions from the audience were about robotaxi.
Yeah.
You and I have discussed this in the past, but Lyft has a complicated history with robotaxi. I think at the core of their question is, will you survive in a world where, Zoox has a really big runway, Waymo appears to have a really big runway?
Yep. Yeah, so we will survive. Let's just take that off the table right now. Because I think the way to think about it is this. It's one thing to create a robotaxi, and both of those companies are doing really incredible work. I'm super, super impressed with the technology and how it's coming together. But it's a very different thing to 2 million times a day pick people up, drop them off, do it in weird weather, do it at airports, and so on and so on. And so I think it's a much more likely scenario that one displaces the other, that actually we work together, right? That we end up. Because if you're a robotaxi company, and I know you've taken, for example, the Zoox robotaxi, gosh, you need a lot of volume to really drive the numbers. Otherwise, you make 10 cars, costs you, $10 million a car. It doesn't make any sense. So you got to have someone like us as a partner who can really incorporate them into our network. And I think that's the most likely scenario that, a bunch of different companies I think are going to work on.
No soul-crushing commute for Ed when he's in that Zoox, playing around with that. David, I'm interested in, you can work together with robotaxis, but you're not going to work together with Uber. And I'm interested as to, ultimately, they're really focusing on this advertising focus too.
Yeah.
Is there room enough for both of you? How are you going to compete for that?
I don't think we have to compete for that. Because I think this, one of the things I learned from Jeff Bezos is work on things that are durable. If you're going to build a big business, work on something that's durable. Okay, I can predict in 5 years, 10 years, 100 years, there are going to be companies like the ones we work with today. Chase, NBC Universal, Delta with their SkyMiles program, Kroger, IHOP. These are 5 companies that we're working with today. Every single one of those companies or their siblings or their brethren are going to want to talk to customers in new ways. And we've got 2 million rides every single day. So no, I don't think that this is one of those zero-sum things. I think actually this is a whole new category of mobile advertising. I think we're going to get there first. I think we're going to do it better. But if other people want to follow us, then more power to them.
You, of course, worked for Amazon. You worked for Microsoft. You learn a lot from those businesses. And both of those are plowing forward in artificial intelligence. I'm sure you are too.
We are.
How much can you use my data as a Lyft user to dictate what ads I'm seeing, make it more specific for me, without weirding me out?
So, great question. I would actually turn it around a little bit and say, of course, artificial intelligence is going to revolutionize a lot of different businesses. I would start actually with our drivers. Look at all the different ways drivers interact with our platform right now. By the way, 41% of our drivers don't speak English as their first language at home. So imagine a world where artificial intelligence can help with simultaneous translation. Every single one of our drivers wants to earn more on our platform. Imagine a world where drivers can use an intelligent assistant to help them figure out how to spend their time so they can earn even more on the platform. And then you get to the targeting side. And our goal is going to be to make the targeting so seamless, you think of it as a benefit. You're like, oh, wow, this is fantastic. I'm literally getting a coupon off of my favorite. What's your favorite toothpaste, out of curiosity? Do you have one?
I'm using some weird one made in India that doesn't have fluoride in it. I've gone into that big rabbit hole.
You're one of those people. Okay, fair enough. Well, you know what? I use a product called David toothpaste. I don't know if they're on the line now. I hope they become a sponsor. Sorry, you've got a personalized. It's not personalized. It's just pure coincidence. But they're also, I think they have a different formulation than fluoride. I don't know. I'm not so focused on that. But it's a very nice tube. I can tell you that. So imagine I'm going to CVS and I get $5 off my David's toothpaste instead of the big, long, ridiculous thing that you get after you check out there. I think it's a better experience.
David, on the AI note, I got a very specific question from an audience member on X. How is Lyft leveraging AI? Is it truly a buzzword for them, or are they really making use of it in a meaningful way? And you gave the example, or a couple of examples there from the driver's perspective. What about the rider's perspective, and what about your internal use?
Sure. So all three, right? So internal is really about productivity and quality, right? We use AI to check our code. We use AI to come up with different ideas sometimes as kind of idea starters. Anyway, a lot of interesting things there. For drivers, I just mentioned, a great way, I think, to sort of maximize earnings as an example. And I think for riders, imagine a world, here's a scenario that I bet has never happened to anyone listening. You ever leave your iPhone in the car? And how fun is that experience? This, 2 minutes later when you realize you don't have it. Well, AI is pretty good at detecting patterns and understanding that, gosh, the car is moving one way, you've just gotten out of the car. What's going on here? Maybe it can reroute the driver back to drop the phone off for you. So I think, look, you can overhype AI. Maybe it's not going to cure cancer tomorrow. Probably isn't, to be honest. But I do think that every single day, if we're customer obsessed, and that's going to be our focus, customer obsessed AI, we can use it in really innovative ways.
Lyft CEO David Risher, thank you so much. We appreciate you coming into our world headquarters.
Always a pleasure.
In New York. Good to see you. All right, coming up on the show, Mike Lynch was accused of pulling off Silicon Valley's biggest ever fraud 13 years ago. He's now been cleared. We have all the details next. This is Bloomberg Technology.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
This industry of producing
Canadian dollar weakens to a near 1 month low at 1.3747 per dollar.
Experts in C++ and C. But the world has many people who knows how to converse and ask somebody for help. Instead of instruction-driven computing, it's now intention-driven computing.
It is noting the dollar extending gains as the Dixie up around 0.8%. S&P 500 back around flat on the session now, just down slightly.
Along with all these incredible innovations, it's causing a new industrial revolution.
This is a tsunami, Ed. This is a tsunami of change. And only the smart ones are going to recognize I have to plant the flag now.
Nobody covers technology like Bloomberg. Context changes everything.
Okay, time for Talking Tech. And first up, SoftBank-backed travel app Yanolja is said to be planning a $400 million IPO in the United States. Sources say the South Korean startup is eyeing a launch in July with a valuation of between $7 and $9 billion. A final decision has not been made, and details of the offering could still change. Plus, AI startups in Silicon Valley are stepping up efforts to stop a California bill that would place public safety guardrails on AI, saying it would curtail innovation. The bill aims to mitigate catastrophic risks posed by future AI models, such as weapons development. The measure awaits action from the State Assembly, which has until August 31st to pass the measure. And UK tech tycoon Mike Lynch has been found not guilty of criminal charges. Lynch was accused of using accounting tricks to dupe Hewlett-Packard into buying his software startup Autonomy for $11 billion in 2011. The outcome marks a redemption for Lynch, who for years argued that he was used as a scapegoat for the deal, Caroline.
Extraordinary, particularly anyone who's reported on the UK tech scene, such as both of us have. Let's talk to Rachel Graff about this, because, Rachel, here's a man who advised several prime ministers in the UK, was a pin-up for what entrepreneurship could be, and then he completely fell from grace. Is this the redemption?
I think it is. He was found guilty in a civil case in the UK. He's still facing potential monetary fines for that. So he's not completely off the hook, but it's a stunning victory for him in the U.S.
What did the judge say? What was the legal reasoning that came to the conclusion of not guilty?
So it was actually a jury here in San Francisco, and after the verdict, the jury said they didn't find a whistleblower at Autonomy who says that he alerted Lynch to the fraud and was then fired in retaliation. They didn't find him to be particularly credible, and they didn't think that the government proved beyond a reasonable doubt that Lynch was directly involved in any fraud.
When I was reading your reporting, Lynch and his legal representation team said, well, the first thing I'm going to do is go back to the UK. Do we see the prosecution try and do anything as a next step, or?
The judge yesterday, after the verdict, held another hearing saying that Lynch he's free to go home, basically. He was under house arrest and 24-hour supervision here in San Francisco during the trial. The judge lifted those restrictions, and so he's free to go.
So, too, was the VP for Finance as well, who's also cleared, who said basically he'd been robbed of 10 years of his life. Audible gasps, crying when the judgment was read out, Rachel. Ultimately, what does this mean for HP as well, when basically put on them as to what happened with the unraveling of Autonomy's market capitalization?
Yeah, so HP was not a defendant in this case, but one of Lynch's arguments all along has been that HP made a bad deal, and they've been trying to scapegoat him. I mean, it was an $11 billion deal. They had an $8.8 billion write-down the year later, and he says that's on them. It was a bad deal. It's not his fault, and so it's not good for HP.
Bloomberg's Rachel Graff. Great job. Terrific reporting. Thank you very much. Let's get to another important piece of Bloomberg reporting and Bloomberg's Brody Ford. And this is a really interesting one, mate, because you have lifted on the lid on a company I find quite mysterious, Oracle, and their contract with the U.S. Department of Veteran Affairs. Just explain the basics of your reporting.
This is one of the biggest federal IT tech contracts ever. $16 billion to modernize the Veteran Affairs, back-end medical records system. Huge undertaking, lots of money involved. Was given to a company called Cerner, now acquired by Oracle. And this contract has had a lot of controversies. They've had a lot of difficulties implementing it. They've had some highly publicized patient deaths, outages. And Oracle has said that, hey, look, you're renegotiating it, but we can handle it fine. We're improving things. Things are going well. What we found in these documents is that satisfaction rates among users of this new system are lower than any other system they have data on. I think it's like 19% of doctors and nurses are happy with the system, say it can provide high quality care. And so these numbers reveal to us that, again, one of the largest tech contracts in government history is really going much worse than we realized.
You've actually been relentless on this reporting, Brody, in terms of highlighting that this Cerner part of the business is just not going as well as many would have anticipated. They're losing market share, was one of your reports, and ultimately the way in which they sort of adopted the business. Last thing we knew, Larry Ellison was going to be moving to Nashville because he's becoming much more of a healthcare company, but this doesn't seem to be in line with that.
It's a long history of tech companies thinking they can break into the health market, right? When Oracle bought Cerner, they said that we're going to be able to expand our earnings massively. Reporting we have shows that a couple years out, the revenue is down in large part because of this VA contract that's been on pause. So yeah, I mean, this is a classic tale. Amazon's been there, Google's been there, Apple's been there, where healthcare is a hard nut to crack, and folks continue to learn that.
Does Larry refocus, therefore, on the gift that keeps on giving, which is artificial intelligence, and re-pivot away from being all things digital health?
Well, one thing is that when it comes with this digital health system, a lot of data. And so a lot of people figure that all of the patient data in here, this could make a really good AI system at one point. We don't have it yet, but 5 years from now, I mean, their long-term vision for modernizing Cerner is genuinely compelling, and obviously we know that the health system is not doing well. I mean, we could certainly use a better solution. So I think, as you say, with all the data, the long-term vision is compelling. The near-term difficulties have been much more than it seems they anticipated.
Brody, great reporting.
Thank you.
Always on Oracle. Thanks for coming in and talking us through it, Brody Ford there. Meanwhile, coming up, there's some great reporting to be had on GameStop too. Shares absolutely slumping. Why? Well, actually, on their fundamental part of the business, the earnings, they dropped them today, surprisingly, worse than expected. And we're awaiting all-important Roaring Kitty's appearance on YouTube. That's less fundamental. We'll have all the details. There's a Bloomberg Technology.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And, you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the
Azeri
losses,
BTC
and
crude
lessons
oil
learned
exports
along
from
the way.
Ceyhan Port set at
Show's called The Deal.
19.19 million barrels in July versus 18.4 million barrels in June, according to a schedule.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Go figure out how to get exposure to hyperscalers, which we think will be the biggest winner in what AI and data storage will do for the world.
Welcome back to Bloomberg Technology. Ed Ludlow in San Francisco.
Caroline Hyde in New York, digesting a very strong jobs report. Let's get to the markets quickly because there's a macro kind of a day when you have 272,000 jobs added, much higher than any of the economists we surveyed thought. And we're currently seeing, therefore, actually the NASDAQ being pretty resilient in the face of a very hot economy that maybe the Fed can't cut into, but the bond market less so. Look, Ed, we're seeing about 12, 13 basis points add across the curve. I shine a light on the 2-year, but similar moves to the 10-year as well, as we anticipate maybe the Fed can't cut in the way that the market had anticipated. I'm looking, though, at Bitcoin also shaking off some of this worry that good news is bad news, because we are risk on. Once again, 18 straight days of gains for Bitcoin. A phenomenal run streak that we've seen at the moment. We're up another 0.5% near that all-time high. Move on and see what's happening on individual names. Look, it's a jobs data kind of day. I wanted to shine a light on ADP because actually this particular data provider, HR Services, it's the best performer on the NASDAQ 100 today. We're up more than 1.6%, which shows that actually nothing's moving that much. However, they are showing from Bloomberg Intelligence Analysis that they're going to be really resilient within their market share area of HR.
The Europe Stock 600 down around 0.2%.
After the bell today, that is when you suddenly see your one share divided into 10. We've still got the same overall value of the company, and maybe retail investors get back into the name, but we have had such a run in this. Of course, we know that it's up near $3 trillion. Maybe we're just taking some profit ahead of that retail event. And I'm looking at what's happening with the retail frenzy that is GameStop. We are down, down, down today. Look at it, down by 19%. That on the basis of fundamentals. Let's also then dig in a little bit more on the fundamentals, the fact that their numbers are not living up to those 2 analysts' expectations, but actually there's a lot more than fundamentals on this particular company, Ed.
Is it fundamentals? GameStop is a company that sells video game stuff and memorabilia in physical stores, and haven't got a clue really what's going on. One person who does is Bloomberg's Bailey Lipschultz, the GameStop meme stock czar of the Bloomberg newsroom. So Karo's right. They surprisingly release earnings. They do an equity offering, and Roaring Kitty is going to speak in 28 minutes' time. Explain what's happening, please.
And so much is going on. So we'll start from the top. The stock was up double digits overnight and into this morning after rallying about 50% yesterday as Keith Gill teased a return to YouTube for the first time in 3 years. We then saw GameStop pull forward earnings. It was scheduled for Tuesday. They surprise released them this morning and then quickly announced that they will launch an at-the-market offering that could sell another 75 million shares, which on current levels for that stock could raise close to $2.7 billion. Again, they did this back in May, raising almost $1 billion. after Roaring Kitty made a return to X. So all eyes and ears will be glued, as you mentioned, in 28 minutes, 27 minutes onto Roaring Kitty's YouTube page to A, confirm if it's still him, and B, try to get some sense of what's going on with his investment, which he's touted on Reddit and also has really posted over the last 4 weeks, pretty nonstop on X.
And that could be worth almost $500 million now, according to your maths, when you're looking at the overall holdings of shares and options. There's so many directions to go here, Bailey, because we could focus on the fact on whether GameStop itself is exploiting this moment and shareholders by diluting them yet further, or whether they're being savvy. We could also dissect the fact that here is Keith Gill potentially, even manipulating the market. That's something that we're starting to hear talked about.
Yeah, that's a concern. We've seen the Wall Street Journal reporting that E-Trade is considering banning him from their platform, which makes me feel a little bit better if they're in fact actually can confirm that he is taking these stakes and making these investments in the company. But Caroline, the main thing that stands out when you look at kind of the concern around market manipulation, when I talk to securities lawyers, you need to be able to prove an intent to manipulate the market and follow through on that. So far, he hasn't sold the stock, as far as we know, according to those screen grabs. He hasn't done anything with those options. So it's really a weird area that has not really been discussed in the past. But one thing that did stand out when I was talking to an investor this morning is he said back in 2021, a lot of us thought it was funny. No one's laughing right now. The SEC seemingly is investigating, and E-Trade, obviously, and Morgan Stanley are looking into it.
I actually get all of that. I think it's worth a bit of a history lesson here. So, I joke, but GameStop is a physical retailer of video game stuff and associated memorabilia. And, as depicted in the film Dumb Money, when Roaring Kitty, aka Keith Gill, started all of this, his explanation was, as Caro pointed to, like, he believed in the fundamentals of the business. Just give us that historic context, Bailey.
Yeah, if you go back to 2020, Ed, sales were slumping. There was a lot of uncertainty around what the fundamental argument for GameStop in a world where people are increasingly downloading video games is, and how the COVID dynamic would actually shift that, because if you play a video games on your PlayStation or your Xbox, you don't have a need to go into a physical store to buy those games anymore. His argument was that the stock was so beaten down that there was an opportunity. He also was the first to call out the fact that about 140% of shares were sold short. So a short squeeze had kind of been ripe for the opportunity. He also kind of tailed the investment from Ryan Cohen, who's now the CEO, that he took in late 2020 and then added to in 2021 when he ultimately took over the board. So when you look at the history of Keith Gill's position back to 2020, when people really were ignoring him because the stock was going down and he was just someone on YouTube talking about investing in the stock, some of those aspects did kind of come to fruition. The main thing that analysts and investors point to now, though, is the stock right now was trading with a north of $15 billion valuation. So the argument that his deep value analysis that played out is kind of potentially overdone, just given the fact that the fundamentals of GameStop, as we saw with the quarterly results, are not improving. We do not have a real argument for what the path forward looks like from Ryan Cohen. And when you look at it on a fundamental basis, which analysts prefer to do, there's a lot of uncertainty in just how you could get to a $16 billion valuation given drying and slowing sales in a market that seemingly is continuously squeezing GameStop out.
A whole 2 market analysts rate this stock, I believe, and it's currently trading at a forward PE of 3,695. Go figure. Bailey Lipschultz, no one's laughing this time, especially, well, it wasn't the hedge funds last time either, was it? We appreciate it. Meanwhile, Apple, let's talk about that, because they're introducing a new homegrown app next week called Passwords. Look, it's an effort to make it easier for customers to log into websites and software that's according to sources. Let's bring in Bloomberg's Mark Gurman for more on this. And look, plenty of people out there use LastPass, 1Password, and it's clunky, but it kind of makes us feel satisfied we've got enough protection. What is Apple offering here?
Yeah, so as part of the company's next operating system updates, they're going to launch a whole load of new features, from AI to new types of emojis to new texting features. But one new application, at least, will be part of the story. That's Passwords. It's going to be a competitor, like you said, to 1Password and LastPass. It'll be a dedicated app where you're able to store all your login information for websites, secure Wi-Fi passwords. You'll be able to use passkeys which is a new initiative from Apple, Google, and a few other tech companies, where you use Face ID or Touch ID in lieu of a password. And it's sort of this encrypted phrase that's stored directly on your devices, so it'll support that as well. And the idea here, like you said, is going to get more people to securely encrypt and store their passwords. And this is going to be stored using a service called iCloud Keychain. This has existed for some time on Apple's devices. Before, to access your passwords, you had to do so from an interface within the Settings app. Now it's a standalone dedicated app, and that's probably going to boost usage quite considerably of their password storage service.
Mark, Apple WWDC on Monday, you've reported that we will get something called Apple Intelligence, and finally Apple will show its hand in the generative AI era. Give us your preview, please.
Apple Intelligence, that is going to be the core element of WWDC on Monday. Obviously, the passwords thing I talked about is only going to be a small bit of that. Apple Intelligence is Apple's push into artificial intelligence. The plan is to add AI everywhere, infuse it with all of their core applications, messages, Safari, mail, notes, calendar, voice memos, reminders, music, pushing AI everywhere in a very privacy-conscious way. Now, in terms of Apple's own in-house tools, there's not going to be a ton of generative AI. For the generative AI component, that's where they're going to be really focused on a partnership with OpenAI, having a generative AI chatbot, basically a bespoke version of ChatGPT within the iPhone on-device Spotlight search engine, right, and components of Siri. So you're going to get in-house, on-device, large language models from Apple to power the AI within applications. You're going to have an iCloud-based infrastructure using Mac chips to power more components of the AI initiative. And then you're going to have OpenAI to power the generative AI part of the initiative. So this is a three-pronged approach. Apple believes it has a strong story to tell. Personally, I think they're playing a lot of catch-up here with their AI initiative. But again, they have a user base of over 2 billion devices. And so overnight, they are going to naturally become the open market leader of artificial intelligence.
Bloomberg's Mark Gurman, an absolutely astonishingly detailed WWDC preview, and you're often absolutely spot on. We look forward to it. Coming up on the show, we're going to bring an end to our New York Tech Week coverage and sit down with one of the city's most valuable startups. The president of Data IQ joins us next. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well, because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions. Wednesday, the Fed decides.
What data is important?
What would it take to reintroduce the rate cut conversation?
It's the labor market cracking that's going to allow the Fed to really enact some of its easing.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Inflation is still too high, and the path forward is uncertain.
They believe that policy is sufficiently restrictive.
The Fed can only deal with the data that it has.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
This is Bloomberg. Oh, New York Tech Week. It's coming to an end after the technology industry in NYC has gathered for a week of events, of panels, of conversations, of parties, and I'm pleased to say, not too exhausted by it all. It's one of New York's most valuable startups. Joining us now is Dataiku President Krish Venkatraman. Dataiku is actually a leading AI and machine learning platform for enterprise companies. Basically, you're selling universal AI platform. You help with governance, with cost management, with security of generative AI applications. You're based here in New York. Interestingly, you've also got a hub in Paris.
Yep.
Why these two ecosystems? What are they doing for you?
Yeah, we were actually founded in Paris. Our founders were all French, either mathematicians. And France is becoming, especially Paris, is definitely becoming a center of AI. Great education. And if you talk about regulation, of course, we're talking about AI, you have to talk about regulation.
Yeah.
The Europeans tend to be a little bit ahead of the curve in terms of regulation. And of course, a lot of the regulatory aspects of where Europe is actually heading towards will come to the US, will come to Asia, just like GDPR. So actually seeing what's happening in Europe, especially on AI, is going to be critical for global enterprise companies.
And therefore it helps if you're selling them governance and ways to sort of look around corners. But does it also then make the future opportunities a little bit slower to take the bite? Are CEOs a little bit nervous about jumping full into generative AI?
No, I think we largely sell to enterprise. And you can't find an enterprise company which is not regulated, right? Whether it's oil and gas, insurance, financial services, you name it. And instead of thinking of governance as more like a lack of innovation track type of concept, I think finally we started to think about governance in a little bit different way. So we at Dataiku are talking to our clients, and we largely sell to very, very large enterprise companies. We have over 10% of the global 2000s, for example, very, very complicated global businesses. And we're really trying to educate them in terms of what governance, what regulatory aspects that they have to actually tackle right now. Because as you correctly identified, if CEOs think, hey, this governance thing is going to be very opaque, I really don't know where to invest, how to invest, and let's be honest, AI is not cheap. It really requires a rethinking in terms of how they actually distribute their either data or IT budgets. But I think we are doing a very, very good job of actually going ahead of the curve, really speaking to them so they actually can create those guardrails right now in their organizations. And for AI
Dollar CAD rises 0.7 cent to 1.3759, the highest since May the 8th.
Everybody can use an enterprise. We have to completely rethink who are going to be the users of AI. Yeah. It's not only going to be the data scientists or the data engineers. You don't need a PhD from Stanford to actually figure out AI. We have to rethink how the whole concept of AI is going to create value.
Well, Krish.
Ed.
You said it just then, AI is expensive, right? And we reflected earlier in the show in the context of the jobs data that there are a finite number of computer scientists and software engineers from Stanford or otherwise.
Yep.
Are you able to get the people that you want in New York and in Paris? And are you paying them over the odds?
I think we have to think about AI completely differently. I think right now we are thinking about AI really from a lens of compute and the hyperscalers. And if what we do, and what we do really special in Dataiku, and I'll go back to your question, why we can actually go attract really high quality talent, is we think of AI as something that everyday users in an organization should be using. So not only the data scientist, but the person who works in finance, the person who works in HR, the person who works in legal, the person who actually works in manufacturing. Those people don't need an advanced degree to really take the value of AI, because right now what we are seeing behind the scenes in terms of AI, most of the investment and the value creation, both for companies as well as for investors, is going to come in the application layer. Just like in the early days of the internet, we put a lot of fiber, right? We built a lot of large data centers. But the people who really created value are, in essence, the people who actually created the application. And similarly here in AI, you'll actually see that we hire both scientists as well as regular folks, because they are the people who can really understand the needs of the end user and actually can drive sale.
I'm sorry to cut you off. We got to go. Data IQ President Krish Venkatraman, great to have you on the program. Thank you. Okay, coming up, we're going to be joined by one of San Francisco's candidates for mayor, Daniel Lurie, for a conversation on the future of this city. That's next. This is Bloomberg.
And according to a program, BTC Azeri light crude loading set at 619,000 barrels per day in July.
Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key.
You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
So just keep in mind, in 10 minutes' time at the top of the hour, Fed's Cook is slated to be speaking. So they're not due to be speaking on monetary policy or the economic outlook, as this is the Fed blackout period, and that is outside of her jurisdiction at the moment. But again, Fed's Cook is slated to speak in 10 minutes' time, just not expecting any monetary policy talk from her.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost of living.
The United States' ability to spend without constraint is not unlimited.
We're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We do need more innovation, more investment, single market and capital market union, and a relevant trade policy.
Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
San Francisco's mayoral race is ongoing. We've been talking to some of the candidates about their vision for the future of this city. Some say its tech-centric nature needs to be harnessed. Others say it's too tech-centric. Let's get the view of another candidate, Daniel Lurie, founder and former CEO of Tipping Point Community. And Mark Farrell has been on the show and basically said we are over-indexed historically to tech, but they've left. We desperately need them back. You share that view, but you want to specifically focus on the corner of the technology industry that's looking at green energy and climate.
Well, first, Ed, thanks for having me. San Francisco is coming back. There is not a question in my mind. This race is about how quickly. I'm running against a number of City Hall insiders who, frankly, got us into this mess, and it's not going to be done by anyone from inside that building. It needs accountable leadership. It needs new ideas. I'm excited today to talk to you about my proposal to bring a climate innovation hub here to San Francisco. Ed, you've just had many guests on talking about AI. San Francisco is already the center of AI, but we need to marry that with...
I've heard that a lot with respect, Mr. Lurie. What are you actually going to do? You know, what is a concrete policy that's going to get a company to say, yeah, you know what, he's going to fix the city?
First off, we're coming back. We have the best research institutions. We have Meta, we have Google, we have OpenAI,
but that's not policy,
and we have open office space. We have 22 Salesforce towers of open office space. We have to streamline permitting to invite clean tech companies back here. You need a mayor with vision that no longer is going to say business is a bad word, but we're going to embrace tech, clean tech. We need to do this. We need to do it with new vision and new leadership, and that's what I bring to this race.
What kind of, I guess, coalition are you building, Mr. Lurie? You know, who are the companies and existing industry leaders that you feel are backing you?
Well, I have a track record of bringing together the business community, the nonprofit community, the civic community. Mayor Ed Lee actually asked me to chair the bid for Super Bowl 50 back in 2013. We had to go up against Miami. I led the cheerleading for that effort. We won the rights to bring that game here. We brought $240 million worth of economic revenue to San Francisco and to the Bay Area. And guess what? We created the Bay Area Host Committee. We got the NBA All-Star Game coming here next year. We have Super Bowl 60 coming back. We have 6 World Cup matches coming here. The eyes of the world are going to be on San Francisco again, but we have to do the basics, Ed. We have to have clean streets. We have to have safe streets. And not just when the JP Morgan Healthcare Conference is in town or APEC is here. Simply put, we need new leadership, and that's what I provide.
There's a political risk here that it's not just mayoral candidates coming up, but there's also a presidential election that might not be that supportive of climate tech. How do you ensure that we're not going into a bust situation, that you're betting on the right ecosystem here, Daniel?
Well, listen, we all know we need to have decarbonization. We have a climate crisis. We all know that. When you're looking at companies like Meta, Google, they need more energy, they need more power, and they have their own climate goals. And so this is a technology that is just getting started.
I'm sorry to interrupt, but I just want to get to the idea of what the city will become.
Yeah.
You know, one vision associated with your name is Wall Street for Climate Tech Bros. Is that a fair label?
No, listen, this city needs to get back to its roots. We need to be focused on arts and culture. We also need to embrace business as well. For us to be a great American city, we also need the tax revenue that we have lost. Under the current leadership, we have seen businesses fleeing this city. It's time that we go win business back. I've done it before, and I'll do it again.
San Francisco mayoral candidate Daniel Lurie, grateful for you coming into the studio.
Thank you for having me.
And as and if the brace progresses, come back again. Caro.
Fascinating, the way in which cities continue to evolve. We've talked New York, we've talked a bit of Paris, San Francisco, but look, this is the end of this edition of Bloomberg Technology. A lot to look forward to for next week and indeed in a few minutes' time.
Yeah, I mean, just incredible what's happening next week. NVIDIA, Apple, and Tesla. I'm away, but Caro, you got this, and in many ways I'm envious. Check out the pod, you know where to find it. From San Francisco and New York, this is Bloomberg Technology.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job
As expected, Fed's Cook does not comment on monetary policy or the economic outlook in their commencement address.
When you want it with Bloomberg News Now, get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
From New York City for our viewers worldwide, I'm Shonali Basak, and Bloomberg Real Yield starts right now. Coming up, U.S. payrolls coming in stronger than expected. Traders pushing back their bets on a Fed rate cut to December. And thanks to the data, Treasury yields surging across the curve. But we begin with the big issue. Payrolls change the conversation.
This is a really strong report on the demand side.
Stronger than what people were expecting.
The non-farm payroll number,
payrolls data.
Probably the most market-moving data point of all. It does close the door on a July rate cut.
Jobs, labor market, consumer spending, those are the key kind of risks to be monitoring.
We want the labor market to normalize.
There's a limit to the painless labor market rebalancing that we've experienced.
At some point, you do have to deal with the slowdown on the way to those rate cuts.
The risk for the chairman is to cut too early before there's any economic weakness and then having to reverse course.
The next move that the Fed is going to make is ultimately going to be one that protects the strength of the labor market rather than one that in which they need to be fighting inflation.
The bar for bad labor market data for the Fed to be cutting sooner than the market is pricing is pretty low.
It all ties back to this labor market report.
Now let's start by looking at treasuries across the curve, because of course when we've seen that stronger than expected payrolls data, you just saw an absolute surge from the 2 years to the 30s, and you look at the 2-year, you're now standing at 485, 13 basis points higher, certainly now higher than where we've started the week, but lower than where we started last week. The trend has been a bit lower, but still you've seen some critical levels being crossed here this week. You saw the 10-year that earlier in the week was below 430, firmly below 430 actually, now jumped past that 440 level. And if you look at across the curve, the moves have not been quite proportional, which means that you're standing at a 210 curve.
JP Morgan changes their first Fed rate cut view to November from July.
530s are less inverted. Of course, a lot of traders across Wall Street betting on those steepeners, and some of them feeling very burned today. Want to flip up the board here and also take a look at the changing expectations on when exactly we might see that first rate cut, and
that top line there is that expectation for as early as September. And you saw in the middle of May, it was almost a sure thing. You saw more than a 50% chance, at least, that a September rate cut would materialize. And you now see that if September through November, those chances are still very much wavering here. And the December rate cut is the only one that is seen as more of a sure thing by the market. Now, we saw the economists over at Citigroup, who were some of those last holdouts still predicting a Fed rate cut back in July, push back their forecasts. They wrote, "We are shifting our base case for that first rate cut from July to September due to surprisingly strong job growth." We're going to see now what our guests think. Joining us now is Matt Dizak of Bank of America and Gargi Chowdhury of BlackRock. And Matt, you had written over to us that really it's about not just inflation here anymore, but the idea of what jobs can mean for the Fed's picture, and of course the market seems to agree.
Yeah, we're not concerned about this job report. It's a continuation of all the themes we said, and it doesn't really change the story for us. Full credit to my friend and colleague Mark Cabana, our head of rate strategy. He's been saying we think the cut comes in December and not sooner. And again, if we were talking in January, it was 6 to 7 cuts, then 5, then 4, then 3. So it's been moving in that direction. And again, we feel that from a high-level perspective, we are where we need to be. The Fed is where they need to be. Rate hikes will work if you give them time. There's a monetary policy lag. We're not even through that lag yet. Once we get through that, once deficits come down a bit, they continue to take out liquidity, rate hikes are going to bite. We feel we're in a good zone for the Fed right now.
Another bank, as we're speaking, really throwing in the towel here, JP Morgan crossing the wire, changes the first Fed rate cut expectation from July to not September like Citigroup, but November. Gargi, when do you think that we can see the first one actually happen here?
Shonali, good afternoon. It's so great to be here, and thank you for having me. I think that what the data today made us realize that July is definitely out of the picture. There's just not enough time for the Fed to gain that confidence that they're looking for. And as for the rest of the year, I think, both September or December are still probable. And I think they are going to be very data dependent. Chair Powell has told us that the data is going to direct them. And I think we just have to wait and see what the inflation data gives us over the next couple of months. And obviously, that'll start with next Wednesday. We're all looking for the CPI to continue to show a little bit more progress coming down gradually, especially on the services front. And if we continue to see that deceleration in inflation, I think 2 rate cuts starting in September is still possible. But as of right now, too early to tell.
How do you think of this trading strategy here, Matt? Because there are a lot of people who started this year getting into duration. And of course, you see what happened with the 10-year alone this week. So how much confidence do you have in terms of advising people to deploy across the curve when even the short term is so uncertain?
So we feel fairly confident that we want to be in a slightly long duration position right now. And to be fair, we've been that way for a while. We got to that 4.5% to 5% range October, November last year. We liked duration. We had a massive rally as Powell got dovish to 3.8 on 10s. Now we got back to that 4.5 to 4 5/8 range. We're still positive on that. The way we look at it is that the Fed, we do believe, is restrictive. Let's assume, actually, that the Fed doesn't even hit 2% PCE. Let's assume they only 2.5. Let's assume they hit 3% PCE. Even at that point, the Fed funds rate at 5 3/8 is more than 2 3/8 over an inflation target well above the Fed's target. Give the rate hikes time. The 10-year just peaked in October, November. The Fed funds rate just peaked in July. Rate hikes take 12 to 24 months. Come back to us in 2025, tell us they're not working. We do believe they're working. We're seeing it in the data, not as strong and as swiftly as some expected. But again, we always expected rate hikes to be back into this year. Hasn't really changed the story for us.
Gargi, how do you feel about the trading strategy right now, given what we know today?
Yeah, Shonali, the thing that we've been talking about pretty much from the start of the year is the fact that we do like fixed income here, but where you own duration is really important. So keeping that duration contained in sort of the belly of the curve, the front end to the belly, right around that 4-year point perhaps, and then recognizing that this is an environment not for owning duration, but for clipping coupon. So really allocating across IG, across EM, across high yield with active strategies that can clip coupon at these extremely extremely attractive levels that, you can build a portfolio earning 6.5% yield, which normally you would look at a much riskier, much higher volatility portfolio, but you don't have to do that anymore. So fixed income makes a lot of sense, but stepping too much out in duration, I think you don't have to do that right now, given the shape of the yield curve and given the attractiveness of the front end.
Now, there's an idea brought forward this week by PIMCO that has been getting a lot of attention. I want to get both of your thoughts on this. We spoke earlier this week to PIMCO's Richard Clarida. He says he sees a generational reset on yields that will spur a bond revival. Take a quick listen.
Investors can get an equity-like return, 6 or 7%, without a lot of volatility or interest rate risk. So that's why our subtext is seize the yield advantage.
Now, it's interesting, you've seen the yield move significantly higher, but you're also seeing it's certainly a reset. How do you play that reset, Matt?
And again, we've had Dr. Clarida on calls. We agree with him generally speaking. This is a massive reset. If we were talking back in 2021, real yields were negative 2%. For the privilege of giving the government your money, you'd lose 2% in real wealth a year. $100 now is $80 of purchasing value. We're in the exact opposite direction now. It's 2 to 2.5% real yields across the curve on governments. This is an opportune time to make sure you have a robust fixed income portfolio. And because investment grade, high yield are basically pricing at a 0% chance of recession, we don't think a recession is likely, but we wouldn't say 0% chance. We're favoring rate risk because you don't have to take a lot of credit risk to get decent yields right now.
How do you feel about this, Gargi? Do you think that this is a generational opportunity, or is this a moment in time?
Absolutely. This is an excellent opportunity, but I think, again, like I mentioned earlier, where you play that opportunity is really important. So I think if you look at the very long end of the curve, and Shanali, you and I have talked about this before, if you go out 10, 15, 20 years out the curve, I think that there isn't enough of a term premium being priced in, given everything that we know around fiscal deficits, given the stickiness of inflation, given the uncertainty around elections. I think that, again, looking at the shape of the yield curve, being able to clip coupon in the 5-year part of the yield curve, and to Richard Clarida's point around building a high-quality portfolio with 6 to 7% yield, that is an amazing opportunity for investors, especially, now that we know investors are sitting in cash and we know rate cuts are coming, whether they come in September or whether they come in December, they are coming, and this opportunity to step out of cash to clip that coupon with fixed income, with ETFs or with active management makes a lot of sense.
Matt, what happens if the Fed does not get the opportunity to cut this year? What's the ripple effect?
So that's an interesting point. We've always said we believe we're at or near the end of the rate hike cycle. Even though we believe one cut's coming and more cuts are coming next year, we wouldn't take one hike off the table. But look what happened today. Strong jobs report. But did the 30-year sell off? Did the curve get steeper? No. The curve inverted slightly more, right? The 30-year was the least worst performing. So the Fed actually did have to hike. We're still not that concerned about longer duration. That would just be them getting ahead of inflation, trying to slow the economy. That really doesn't change our view on being so long duration because, again, you saw it today. Strong data was worse for the short end of the curve, not as bad for the long end of the curve. Again, look across the curve, 2 to 2.5% real across the curve. We're not that afraid of duration risk at this level right now.
Gargi, is there a risk that the Fed can't cut or even have to hike?
I think there is a risk that they can't go at all this year. I think the bar is high for them to cut, but I think the bar is even higher for them to hike. I think that if we continue to get some 0.3s, God forbid even a 0.4 on PCE or CPI, I can see a situation where they just hold off for this year, and that's fine. I think the market can handle that. Obviously, if we're talking about a hike again, and again, that is not the base case, don't expect that to be the case. I don't know how much they'll achieve at this point by hiking rates again. So as I said, high bar, but if we do continue to get much stronger than expected CPI and PCE prints, that could be something we're talking about. But Shanali, one thing I will point out that I think the bond markets were reacting to earlier this week is that we're a little bit in better balance in terms of looking at the labor market. Obviously today with the unemployment rate picking up just a little bit, the JOLTS data showing a lot more normalization with fewer job openings, ADP. If you look at the totality of the labor market data, I think you're seeing a little bit of normalization, which is good news for the Fed.
Matt Dizok and Gargi Chowdhury, what a great time to have both of you here. Of course, we have that CPI data and a massive Fed meeting next week. All eyes on that dot plot. But up next for now is the auction block. Donuts, burgers, and whiskey, all three are tied to credit issuance this week. Details on all of that up next. This is Real Yield on Bloomberg.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. The world has very few action-driven computing. It's now intention-driven computing.
You know, this AI opportunity is really tremendous. You have an ecosystem of companies coming together along with all these incredible innovations. It's causing a new industrial revolution.
This is a tsunami, Ed. This is a tsunami of change. And only the smart ones are going to recognize I have to plant the flag now.
Nobody covers technology like Bloomberg. Context changes everything. The top names at the Fed are on Bloomberg.
The way I look at it is, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced.
I do think that our new steady state is likely to be higher than what people have known over the last decade. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context changes everything.
I'm Shonali Bassick, and this is Bloomberg Real Yield. And it's time now for the auction block, where there was a rush of sales before the ECB decision and U.S. jobs. We'll start in Asia, where dollar bond sales climbed for a third consecutive month in May, with new offerings since March up 50%. With the strong demand, spreads tightened to an unprecedented low of 141 basis points. And Japanese dollar debt sales have not been a part of this rush so far this year, but Suntory was part of U.S. high-grade sales this week, and the deal helped push weekly issuance to around $33 billion. And in U.S. high-yield, issuers bought more than $8 billion worth of deals. Notable names include restaurant brands and Brinks. And when it comes to credit, Invesco's Matt Brill says returns will come eventually.
We came into this year thinking it would be the year of the bond, and here we are 5 months in, and returns are basically flat on the indices, which they were down, so flat is starting to look like a little bit of a win. Going forward, we do believe there's significant money to be made within fixed income. So with signs like that cuts are on the way, I think it's sort of a wake-up call to everybody that this is actually going to happen. The soft landing can occur globally as well as domestically, and when that occurs, you're going to start to see all-in yields go lower and the total returns pick up.
Now let's bring in Sonali Pierre, Portfolio Manager for High Yield and Multi-Sector Credit at PIMCO, and Michael Kontopoulos, Head of Fixed Income at Richard Bernstein Advisors. First question's got to go to the Sonali because we are the Sonalis on this show. What do you think about this idea of valuation here, this worry about you're not getting compensated really for the risk you're taking on, given how much money has flowed into credit right now?
Yeah, so spreads really have compressed. At this point, it's more of a yield story. So yields are still compelling overall at nearly the 80th percentile versus history. And if you look at the yields, they're a pretty decent indicator of forward potential returns. And then in an active context, being able to add value through alpha with being selective, whether it's by regional selection, industry selection, security selection, and of course, asset allocation. So while the spreads are compressed today, there's still a compelling story for fixed income, and even more so, I would say, with the fact that we are discussing the potential down the road of the Fed cutting. We're talking about the fact that if we were to wait, we may miss the opportunity in some sense because of the yield that's being produced today, and being invested for that, it makes a lot of sense.
Michael, how much risk are you willing to take on at this point in the cycle? Of course, those rate cut expectations, whether or not you believe you'll see one or even more this year, they're still pushed out. And does that mean that you'll see more stress in the system?
Yeah, Sonali, I think eventually we'll see more stress in the system, but the Fed's just not tight enough at the moment. Everybody, your previous guests were talking about how, the Fed is very tight at the moment, is restrictive. I totally disagree with that. There's no indication that the Fed is that restrictive at the moment. Look at Bitcoin, look at meme stocks, look at the equity market, look at credit spreads. Look at the housing market. Nothing out there suggests restrictiveness. And so I wouldn't expect any sort of catastrophe or blow up that's imminent, because quite frankly, the economy is pretty healthy and it's absorbing these rate hikes pretty well. But eventually, of course, either the Fed will have to get restrictive or earnings will fall or something will happen that will cause a drop in yields and the Fed to ultimately cut. But as I look out over the next several months to several quarters, it's hard to really justify that that's going to be anytime soon. And so from that vantage point, listen, I mean, credit in particular, on a fundamental basis looks great, but I think on a valuation basis, you've really got to look elsewhere other than just corporate credit at the moment.
Well, it's interesting, Sonali, when we were talking to our previous guests too, this idea of not needing to take on too much credit risk to get returns in the bond market. Where does that leave you with the propensity to still take on credit risk, given where we are in the cycle right now?
Right. So I think, the trade-off here is, are we looking for economically sensitive securities, or are we looking for securities that can produce attractive, high-quality, low loan-to-values and still an attractive yield? And so, we can do this in a multi-sector credit lens, through agency mortgages, through financials over non-financials within investment grade, looking at those national champions. We can do it with securitized credit over corporate credit in some aspects, but there are some parts of the corporate credit market that still look attractive. So, within securitized, ideally we're, focused on some areas like residential mortgage securities, and, think there's a fair amount of opportunity and resilience in those securities.
You're talking about resilience, but do you think that defaults are going to pick up elsewhere in the system, Sonali?
Defaults have been relatively low, and even if they pick up off this low level, we still think pretty much in line with the long-term default rate, both in the high yield market and in the bank loan market. And a lot of this has to do with, many issuers have pushed out their maturity wall, right? There's not this maturity wall looming. They've refinanced when rates were low in back half of 2020 and in 2021, such that, there's not this trigger for a high level of defaults. Furthermore, with covenants having been so loose over the last decade and a half, we're seeing issuers now coming, when it's difficult to issue an unsecured piece of paper, they're coming with a secured bond or embarking on liability management exercises, distressed exchanges, to avoid the actual bankruptcy.
Now, Michael, if you could take a look at just how much money has poured in, including into credit risk, do you think that people have maybe gotten in a little above their skis, or do you think they're safe, just given that people don't think the economy is going to turn this materially so quickly?
Yeah, listen, I think it's a little bit of both, quite frankly. It doesn't make for great television, but I agree very much with Sonali. This isn't necessarily a fundamentals story. And so is there an imminent catalyst to significant spread widening and price loss in corporate credit? Maybe not, although one could argue that there's a huge correlation between rate volatility and equity volatility to credit spreads, and credit spreads, any sort of increase in either one of those types of volatility will cause spreads to widen, and that can happen for all sorts of reasons. But generally speaking, listen, it's not a fundamental story here. It's really a valuation story. And so from that vantage point, I very much agree with what Sonali said before. Securitized products, and I'll throw in there, in addition to residential mortgages, agency-backed securities, but also CLOs. Why go and buy a 5% investment-grade corporate bond when you can go and buy a 6 to 8% yielding either AAA or BBB CLO with AA or better default risk. To me, that's a much better value proposition than owning just the investment grade corporate bond market. You take less risk, you get more yield, and then you can use treasuries to manage your duration any way you want.
Michael, real quickly here, you have about 30 seconds. What is your favorite trade right now then?
Well, I think I just mentioned it. I think looking at CLOs, collateralized loan obligations, and in the securitized market, definitely our favorite trade. You can take your risk there, and then you can modulate your duration using treasuries. And I think that's going to create a much better risk-return profile than just buying, run-of-the-mill investment-grade corporates or munis or anything of that nature.
Oh boy, do I wish we had more time. Would love to talk about those leveraged loans that are feeding that CLO engine. Our thank you for now to Sonali's Pierre from PIMCO and Michael Contopoulos from Richard Bernstein Advisors. Certainly an interesting time right now in credit. Now, still ahead, the final spread, the week ahead, huge week. We're going to get a Fed decision and a CPI print. We'll talk about that next. This is Real Yield on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the final spread, the very busy week ahead. Coming up Monday, all eyes on Apple's Worldwide Developers Conference, and Tuesday, the U.S. Treasury selling $39 billion of 10-year notes. Wednesday, the latest CPI print, plus a Fed rate decision and Chair Powell's news conference. Thursday, the G7 summit kicks off in Italy, and more U.S. eco data rolling out, PPI and jobless claims finally Friday. It's the Bank of Japan's turn for a rate decision, plus UMISH consumer sentiment. And for my final thought, closer look at those estimates for CPI. Of course, complicated story when it comes to inflation, and you have to wonder if it's the only part of the story here anymore after this jobs report. But you do see an estimated cooling of month-over-month CPI to only 0.1%, with the prior being 0.3%. Let's see if next week delivers. From New York, that does it for me. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.
decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the praise to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Welcome to Bloomberg Markets. I'm Shonali Bassick. We're looking at that May jobs report blowing past expectations as Wall Street is now quick to push back rate cut forecasts for 2024. Let's get a check on these markets because we are now watching the S&P 500 turning into the green, and that bid in the bond market really still waning here. The 10-year yield 12 basis points, almost 13 basis points higher on the day, and a week that saw the 10-year float below that critical 430 level earlier in the week, that is now wiped out. You're back at 440 or higher, and again, you are seeing those yields move higher across the curve. Broader markets as well, we'll take a look at. We have the S&P 500 off of session highs on the day, but still about 0.3% higher. Same goes for the NASDAQ 100. You have now some green on the screen for the day. A little bit of cooling in the oil trade here, still at $75 or more, but roughly flat on the day after a surge a day ago. Gold spot taking a 2.7% leg lower on the day. And looking at when traders are anticipating a move from the Fed, want to take a look here at expectations and just how much people are pulling back their expectations here. These are the Fed cuts that are priced in, and of course September was something that is now seen as a coin toss. Earlier in the week, expectations were a bit higher. Citigroup and JP Morgan now pushing back expectations away from July, closer to September or November. Of course, most of those expectations from the market in Fed swaps still back in December of this year now. Bloomberg opinion columnist Mohamed Al-Arian had this to say about the latest jobs report. Take a listen.
This is a really strong report on the demand side, not on the supply side, on the demand side, but strong in terms of demand for employees, strong in terms of wages paid, etc. It does close the door on a July rate cut. I think that is it, almost regardless of what the CPI number says next week.
Bloomberg's Michael McKee covers the Fed, joins me now, and now it's interesting to see some of the big banks really push back their rate cut expectations away from July. Of course, the market wasn't really expecting July to begin with, so who really gets hurt today?
Well, there were people in the market who were thinking July. Citigroup, of course, was the most prominent. But as they say out west, there ain't no education in the second kick of a mule. I mean, it basically became obvious that the Fed is not going to be cutting in July when we saw what we got, the jobs number, 272,000, and we saw wages going up. The two things happening at once put a kibosh on the idea of July. But even September, as you mentioned, is going to be a little shaky at this point. And Morgan Stanley went back to November. Under the hood, you take a look at what happened, and basically we got a normal May in the sense that we had a normal non-seasonally adjusted number, and then the seasonal adjustment takes it down by 681,000, and that's basically what we have seen in many recent Mays. So not a huge deal. There's the numbers we got today in terms of jobs, 272, and earnings, 4.1%. The earnings thing is interesting because there's a bit of a calendar quirk in there in that this was a longer survey week that enabled an additional pay period to get into it. But also we had the California minimum wage going up for service industry workers in fast food and healthcare to $20 an hour, $4 more than their other minimum wage. Good news. Prime age participation, highest since 2002. Now, if you want to wear a tinfoil hat, the household survey and the establishment survey diverged a lot. Household down 408,000. Well, we had the 272 in the
U.S. Energy Department seeks 6 million more barrels for the
Of course,
SPR.
there's the jobs data today, but when you have CPI around the corner as well, and you saw
WTI
that
crude
wage
seeing a
data
bit of
you saw
strength here.
today, how does that set the Fed up for Wednesday afternoon for the big meeting?
Well, they're going to get the CPI report on Wednesday morning. If it were some huge surprise, I suppose it could change something, but it's pretty baked in. You were talking about what the markets are expecting, and the one market that didn't change today is next week's Fed futures, because nobody expected them to do anything. That's still the case. And we have basically seen the market price out 2 rate cuts this year. We've got about a 1.5% chance by the end of the year. 100% of one cut, 50% of another. This will change. It'll be very volatile between now and the end of the year. So I think just kind of leaves us not sure what's going to happen, and it leaves the Fed not sure what's going to happen.
Everyone, keep up your WIRP screens on your terminal. That'll tell you how quickly everyone changes their mind. Bloomberg's Michael McKee, we thank you so very much. Of course, I hope you have a great weekend into a very busy week ahead. For more on the jobs market, I'm now joined by Elisabetta Bartoloni. She's a partner at Heidrick & Struggles, of course, one of the largest firms focused on recruitment of C-suite executives and otherwise. And you focus here on the financial services industry and other industries. How do you think about what employers are really trying to do right now in terms of leaning into this workforce? You see in aggregate numbers that, yes, jobs are strong, but the economy is still so uncertain. Do employers really feel good about hiring right now?
First of all, thank you so much for having me, Shonali. It's a pleasure to be here. So it's interesting, you said it right. We basically focus at the top of the house. So our data is really skewed to vice presidents and up. In general, what we have seen this year is employers being very cautious about where they want to put their money in the job marketplace. So we have seen a lot of activity in the M&A market, and so hiring investment bankers with a strong M&A portfolio of business. So what we have seen that has decreased is probably hiring the up-and-comers. That has not been the bullseye of the work. Where we have seen a lot of work is bringing in those proven talent that really can increase the revenue on a certain business.
That's fascinating. So are you saying that employers are really willing to take less of a risk here on people they don't know will be a sure thing?
I would agree with that, absolutely. So there's been a more conservative approach, more focus on revenue origination right away, and a focus also on hiring individuals that do have a very good culture fit. That's something that is being sometime talked about on Wall Street, but culture has becoming more and more important within Wall Street.
Now it's interesting too, because on one hand, to your point, people are adding talent. We see in the wage numbers in the aggregate economy, of course, still pressure upward on wages. In the financial services industry, I'm wondering if some of that pressure is coming from more internal promotions rather than people looking outside to elevate their ranks.
Absolutely. What we have seen is in financial services this year, there's been a lot of more internal promotions. And it's really a combination between doing more with what you have and be cautious about spending the extra dollar to hire externally. But it's also been a way to continue promoting internal culture. Having said that, our numbers, our confirmation numbers for financial services, they've been up significantly in the U.S. And this has been, I would say, a result of a lot of our international banks really focusing on penetrating the US market. And because of that, wanted to hire US talent with strong book of businesses.
No, from the talent side, are people looking to leave their jobs? Are they feeling kind of like they're scared that if they were to go somewhere else, that the opportunity might turn on them, right? We're just seeing deals come back to the point that you're making. Or are they saying that this is exactly the right time because it can start to raise their value, right? You go to find a new job and that's when you get that raise.
Yeah, it's been a combination, to be honest, depending on when you sit. So we have seen a lot of talent today, especially if we look at investment banking broadly speaking. And what I mean is, of course, investment banking, capital markets, and sales and trading talent. Last year, it was a very tough market from a compensation perspective. So that has probably increased the opportunity for talent to look at other opportunities where they could, in fact, get more compensation for what they do. At the same time, of course, nobody is shy of understanding the risk of making a change. So there is a lot of more conversations and time maybe that it takes for a candidate to be comfortable as is looking at another opportunity.
You know, it's interesting. A couple of years ago, there was so much of a focus here on a talent war. Then, of course, we saw the market turn. Now it's coming back. If you kind of had to categorize what the talent war looks like at this point in time, how would you describe what's going on?
For certain positions, is very high. So I would say, again, if we talk about investment banking in healthcare, technology, consumer, those are very hot markets. If we talk about convertibles, for example, that has been a market that a lot of talent from the origination side, sales and trading has been extremely in demand. We have seen also a lot of a request of technology individuals. So if we move to the functional areas, technology has been royalty in terms of really trying to get talent into the companies too. And it's not just AI, it's transformation, it's innovation. So it's a lot of work at the chief technology officer, chief innovation officers, and so on. So I would say that those areas are really hot. Then there are other areas that are probably they're cooled down. And then for that talent that might have found themselves in roles that are less attached to a revenue or these innovation roles, they might be finding themselves into less of a market that is hot for them.
What's the biggest worry at this point among employers as they think about the next 6 to 12 months?
Yeah, so I would say employers are looking very clearly at the deal flow. M&A has been up this year, 20% globally from last year, and in globally and in the US it's been 37%. So that's been really good. Has been primarily at the large cap deals, so the mega deal, the 10 billion and up. So they're looking very closely at the deal flow. Is it going to continue? Is it not? Now, recruiting, however, and especially recruiting from our perspective at the C-level, is very seasonal. So we are very busy in the first 2 quarters of the year. The third quarter tends to be a little bit slower from a placement perspective because individuals start going on vacation. So the personal agenda gets in the way of the work agenda. And then the fourth quarter tends to be more of a strategy time for the year to follow. So I would say deal flow is what they're looking at very clearly, and I would say also there is a natural seasonality into the hiring during the year.
And lucky for everyone, it is also the most volatile time with the U.S. election season ahead. That is Elisabetta Bartoloni, a partner at Heidrick & Struggles, of course, on what is a very complicated and mixed picture for the job market out there, especially on Wall Street. Now, coming up, we're watching shares of GameStop after pre-released earnings, and Roaring Kitty says he's been returning to YouTube. He started his live stream a few moments ago. The stock has been halted multiple times for volatility and is currently down around 30% on the day. We're going to talk about GameStop in our stock of the hour. Up next, stick with us for all the details. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people.
It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Go figure out how to get exposure to hyperscalers, which we think will be the biggest winner in what AI and data storage will do for the world.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Wednesday, the Fed decides.
What data is important?
What would it take to reintroduce the rate cut conversation?
It's the labor market cracking that's going to allow the Fed to really enact some of its easing.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Inflation is still too high, and the path forward is uncertain.
They believe that policy is sufficiently restrictive.
The Fed can only deal with the data that it has.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
This is Bloomberg Markets. I'm Shonali Bassick, and it's time now for the stock of the hour. None other than Roaring Kitty. He's back. Keith Gill has started his live stream on YouTube, and shares of GameStop have been halted multiple times in the session for volatility, including now. It is currently down more than 30% on the day. Remember, the retailer also unexpectedly released earnings and announced a plan to sell up to 75 million in additional shares. Bloomberg's Carmen Reinecke has been covering GameStop, joins me now. It's not the first time that we've seen GameStop turn around and sell shares on the back of increased excitement around the stock. Retail traders should have known?
Yeah, I mean, this is a move from their game book, right? This is the second time that they've done it on this wave of the meme stock trading mania. I mean, GameStop is usually something that's a little bit of a sleepier stock when we aren't seeing this sort of meme frenzy. So yes, this is the second time that they have said that they would sell additional shares. The last time they raised, I think, about $1 billion. So that's obviously very significant for GameStop.
Now, how did the live stream start today? When it came up that Keith Gill would be addressing investors, retail traders, people who have followed him very closely, what was the first thing he had to say?
Well, we were really all waiting with bated breath for this live stream, which was supposed to start at noon, and he didn't come on until about 25 minutes later. So the comments section was a complete frenzy. There were over 500,000 people waiting for the live stream to start at one point. And then when he did finally start the live stream, he sort of did a bit where he was dressed in a bandage and with Band-Aids and being shocked by the comments. And he really just said, hey, I'm back, I kind of forgot how to do this, was one of the things he said. I think he said, I just wanted to pop in and see what's happening. So a very interesting return. Obviously, people have been waiting 3 years to see if he'll say anything. And this recent frenzy trading in GameStop and other meme stocks, AMC is also seeing a lot of action today, was really kicked off by his return to social media. We've been seeing posts on X, posts on Reddit, and then now finally return to YouTube.
Well, what were some of the comments like? I'm curious, and you saw some pictures over there, Keith Gill with the Band-Aids on his cheeks, of course, playing into this frenzy and his relationship with the audience. Has the relationship changed at all? What were they saying today?
Honestly, it seems like it's kind of the same. People were, really excited about hearing Keith speak again. A lot of, let's go comments, a lot of hodl. There definitely was a little bit of anxiety, I think, around the live stream starting so late. Again, everyone was sort of ready to go at noon Eastern. So there were some comments. I saw one saying, oh my goodness, if this were college, we would have left already. Where is the professor? So yeah, and then once the live stream started and he made an appearance, the comment section went wild yet again. So I think that people are really excited about him being back.
Well, excited about him being back, but of course we are also seeing the GameStop shares now actually halted again as we speak. So certainly people engaging with the stock as he is speaking to his audience here. Interestingly enough, remember we had reported earlier that Andrew Left went short GameStop. Do we know how this move is going to impact both Keith Gill and someone like an Andrew Left right now who bet against him?
Right. Well, it's really the long and the short side of the trade. Obviously, if you're long GameStop and you're trading it, short term, you don't want to see a 30% plus drop on the day. If you're a short seller, you might think that this looks great. It's actually down now almost 40%. I'm seeing on my terminal. Andrew Left was on CNBC saying that he thinks this time is different. He has been in this trade before, and yeah, we reported that he's short again. So, it's really interesting. It feels like a resurgence of 2021, and with just a few
So in
slight
10 minutes
tweaks.
time now, at the top of the hour, see the
Carmen,
release of
thank
the
you so
weekly
much
Baker
for
Hughes rig
joining us
count
on
numbers.
this. Of course, a lot
Oil
of
rigs,
people
the
will be
prior was
watching that live stream as well.
496.
Still
Total
ongoing,
rigs,
and
the
as we've
prior
been
was
saying,
600.
GameStop shares on and off halted throughout the day. That's Bloomberg's Carmen Reinecke. Thank you. Now coming up, we're going to talk about wealthy families driving a resurgence in private equity buyouts. Certainly a hot story on the day. We're going to take a look at it on today's Wall Street Beat. Stick with us. This is Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost of living.
The United States' ability to spend without constraint is not unlimited.
We're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We do need more innovation, more investment, single market and capital market union, and a relevant trade policy.
Bloomberg. Context changes everything.
This is Bloomberg Markets, and I'm Shonali Bassick. It's time now for the Wall Street Beat. ultra-rich individuals and families worth more than $150 billion. They're all helping drive a resurgence in private equity buyouts, of course, at what has otherwise been a tough time for the buyout industry. Joining us now is Bloomberg's Christine Aram, who was a part of the team that wrote this story, of course, tracking family offices and wealthy individuals very closely. And Christine, we know that private assets in particular have been of interest to wealthy individuals, but why private equity? It seems like a very interesting time to get in, especially as the industry itself has been under so much pressure.
Yeah, it's a very interesting time in the space. And from the private equity firm's perspective, of course, they're traditional investors, like endowments, pension funds, those institutional investors, have kind of disappeared because they've allocated everything they can or want to private equity for now. And from the firm's perspective, the option is either, okay, so we will need to take on more leverage at high interest rates, or we find alternative investors. And those alternative investors that have emerged are these wealthy individuals and these wealthy families. They've come out and said they are more interested in adding private equity assets to the portfolios, direct private equity investments, than any other type of asset class except for emerging market stocks. So it's an area of tremendous interest among wealthy individuals and family offices right now. They're just chasing the returns on some of these investments, and you can see that in the fact that about $20 billion worth of buyouts that have happened so far this year have involved family offices or wealthy individuals.
Now, are there any prominent examples that we should be looking to that kind of solidify what this trend really means? Surely they can't be looking across the entire industry here at this point.
Yeah. So the most prominent example this year is Michael Dell's family office. Michael Dell is worth over $100 billion, one of the richest people in the world. His family office was involved in the biggest leveraged buyout deal of the year so far, which is a $13 billion deal for Endeavor Group, a talent agency. That hasn't closed yet. It's expected to close in early 2025, but that was a very prominent example of a rich person's family office getting involved in a take-private
In
deal.
5 minutes time now, at the top of the hour, I see the release of the weekly Baker Hughes rig count numbers. Oil rigs, the prior was 496. Total rigs, the prior was 600.
Sexy industry, but they're worth almost $14 billion. And they were involved with a deal alongside KKR to take a renewables firm called Encavis private. And then, interestingly, the family behind Lego was also involved in a big deal with Goldman to buy out a Norwegian learning platform. So it's kind of happening all over the world. It's involving some of the biggest PE names. It's involving fortunes on both sides of the Atlantic. And we're really seeing that trend spread across a variety of industries as well.
Christine, we have to leave it there. We thank you so much for your time. Of course, I love some of the reactions we're getting to this story as well. Cliff Asness, for example, on the platform X, all for earning a few percentage points below their true beta exposure going forward, but not having to mark to market and feeling so much more clever than the average Joe in an index fund. Of course, that private versus public debate keeps going. Now, we're also watching the shares of GameStop. Keith Gill, aka Roaring Kitty, speaking right now on YouTube in a live stream, reminding you he started late, but since he started, the stock of GameStop has been halted, down more than 33% on the day. Mind you, more than 600,000 people are watching this live stream at the moment, and of course, a lot of questions about that potential share sale here, that planned share sale from GameStop. But for today, Roaring Kitty goes on, but I am heading out. I'm Shonali Basak. That does it for Bloomberg Markets today, this Friday. Stick with us through the close. Of course, a very busy day in markets after that jobs report. Very, very busy week ahead with the Fed next week. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains.
Shortly expecting those weekly Baker Hughes rig count numbers. On release, will lead with the oil rigs.
Bloomberg.com and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg. Top experts. Great questions. From the world of politics to the world of business, this is Balance of Power. Washington, D.C.
The job market stays hot, but where's it going? Welcome to the fastest show in politics. With payrolls data out today, renewing the debate over interest rates. I'm Joe Matthew in Washington. Thanks for joining us on Bloomberg TV and radio. Coming up, our conversation with the acting labor secretary, Julie Su, and insights on the data from labor economist Catherine Edwards at RAND. It's all after a look at Wall Street. We start right there, right now on the markets with Charlie Pellet in New York. Hey, Charlie.
Hi, thank you very much, Joe Matthew. And right now we are looking at the Dow Jones Industrial Average. It's been a volatile day. We do have the Dow moving lower now, down 16 points. Actually, the Dow, higher by 82, up 0.2%. The S&P 500 index up 16, up 0.3. NASDAQ up 48, gain there of 0.3%. So stocks solidly in the green. The Dow, the S&P, NASDAQ, all advancing right now. And to be sure, the Russell 2000 is lower by just about 0.8%. 10-year, 4.41%, with a 2-year that's now yielding 4.86%. Spot gold today trading lower by 2.7%.
Total rig count 594, 594.
Intermediate crude up 0.2%. 75.69 for a barrel of WTI. So to be clear, Jobs Friday, the Dow, the S&P, NASDAQ very much in the green right now. S&P advancing by just about 1%. GameStop
and oil rig count 492, 492.
Kitty makes his return to YouTube. GameStop shares after a trading halt right now down by 35.3%. Also keeping an eye on Vail Resorts, looking at a downward slope there for the ski operator. Right now, Mountain MTN on the ticker there. Vail Resorts trading lower by 12% after earnings. So again, recapping, the Dow, the S&P, NASDAQ solidly in the green. S&P up 13, up by about 0.3%. Balance of Power continues now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
Charlie Pellet, thank you on this Jobs Day. With the reaction on Wall Street, fascinating since 8:30 this morning to listen to the analysis and the different takes on the same numbers here. Growth surging in May. You've been hearing about that if you've been with us since 8:30 this morning. Wages accelerating. 272,000, the number last month, blowing the doors off expectations once again. The unemployment rate, though, also up, hitting 4% from 3.9. Just a tick, but not expected. And it brings us to the question of which survey we should be looking at. Bloomberg Economics would point you to the household survey. That includes agriculture, that which generates the unemployment rate. Payrolls stay hot, though, and that's the number the White House is going to seize on here. So we made our way down to the Labor Department to get the take of the acting secretary, Julie Su. And I started by asking her, as we got together on the patio of the Labor Department overlooking the U.S. Capitol, which survey better reflects reality? Here's what she said.
This is another very strong jobs report. I'm not going to get tired of coming here and telling you that we are continuing to experience very strong, stable, and steady growth. So it's 272,000 jobs created last month. The unemployment rate has remained at or below 4% for 30 months straight. That's still the longest since the 1960s. And at the same time, real wages, over the year are up 4.1%. So workers are doing better in an economy in which the president has said, when we focus on workers and worker well-being, we're going to do what's right for the economy and for the country.
When you look under the hood, you find that 400,000, even more than 400,000 people left the labor force in May. The participation rate is not back where it was before COVID right now. How do you explain that?
Well, so let's say, the prime age labor force participation rate remains very, very strong. And it's worth noting that, again, women's labor force participation rate hit another historic high. So last month we said it was the highest since 1948 when this data was begun to be collected. It's now a little bit higher than that even. So women continue to power our economic recovery. At the same time, we are seeing, again, strong participation. People are in the job market. People have come off the sidelines. People are looking for jobs, and they're finding them. Where there has been a little bit of a very small uptick in the unemployment rate, again, still at or below 4% for the longest stretch in decades,
sure.
But has to do with young people ages 20 to 24 who are in a bit of transition, really, if we think about May, right? May is a period of transition for all of us parents with kids who graduate and maybe move and are looking for different jobs during that time.
You can tell a great story and put a great headline number on that unemployment story, as you are right now. But when you look under the hood, you do see some elements of weakness compared to the payroll survey. And I wonder, while you're happy where it is now, if you worry about where we're going to be 6 months from now, if this is a slowing job market.
Well, the payroll survey really is the gold standard when it comes to the unemployment
According
rate,
to Nikkei,
right?
the Bank of Japan is to weigh future of JGB purchases at the policy meeting.
Including the household survey that is used. And so, again, I don't think there's any way to paint this as other than continued strong, stable, and steady growth under President Biden's leadership, and proof of his theory that if we invest in America, we can create good jobs in communities and, crowd in private investment in order to do that. And as I travel the country, I'm seeing the benefits of that.
We've talked a lot about the impact that immigration has on our job market. It can be for better or worse, depending on the trend that you're looking at. And there's an analysis from Steve Englander at Standard Chartered Bank that we looked at this week that estimates about half of the job growth since October can be attributed to undocumented migrants, that it's somewhere in the area of 109,000 a month. If the president's executive order put in place just days ago lowers the threshold, lowers the numbers of undocumented immigrants entering the country, what does that mean for the job market? Do you see numbers like that in your modeling?
I mean, I haven't seen that study. I would actually question those numbers based on what we see. Right? This is a situation where, one, we're not talking about dividing a small pie into smaller pieces. We're talking about a much bigger pie overall. So more jobs, more people in the labor market, more opportunity for all. Since the president came into office, again, we've talked about this, about 15 million jobs created. That is 15 million families, 15 million individuals who are having the benefits of a good job that might not have had that before. I would also say that it is true that there has been, immigration-based growth also, and that has been true throughout our nation's history, right? That immigrants have helped to do jobs and help fuel the economy, but the majority of this job growth that we're talking about has gone to native-born workers.
Well, talk to me about the other side of this story, and that's immigration reform. H-1B, H-2B. We spend all day talking about border security in Washington. What does our job market need in terms of attracting talent from other countries legally?
I mean, it's such an important question, right? This is why, since day one, President Biden has called for the kind of comprehensive immigration reform that would address, some of the challenges that our system has created.
What would our job market look like with that help?
What would our job market look like with...
If you got that reform.
Right. Well, so we do administer... we have, in this administration, increased the number of H-2B workers that have come in. We recently did a rule around H-2A workers, making sure that when migrant workers come to this country through legal means, that they're also protected, right? That they are protected for their own good, but also so that their being here doesn't take away from the good wages in those industries. So we, but the bigger picture is that there does need to be comprehensive reform. The president has called for that, and frankly, Congress needs to do its job.
There's something that I don't want to get too deep in the weeds called the birth-death model that our analysts at Bloomberg Economics are looking at that would suggest some of the companies that we've seen closing might not be reflected yet in the numbers that we saw in this monthly survey. Based on layoff announcements, corporate closures, where do we look in the middle of summer when these numbers start to emerge?
Well, we will come out every month to report the data that we have, but everything that we have seen this past month, this past year, as well as the last year since President Biden came into office, is historic job growth. More jobs created during the same time period than any president in our history, and continued low levels of unemployment. Again, historic lows, and more opportunity to come, right? The investments in the president's Investing in America agenda, many of them are still coming out. And that's why this summer I'm going across the country talking about Good Job Summer and focusing on the importance of what a good job does for families.
The Good Job Principles Summer Tour. You're like Beyonce. You're launching a national tour, and it's not a mistake. I see some of the states you're going to, like Pennsylvania and Michigan. What is your message to voters in those states?
Well, my message to working people is that we see you, we have your back. We know that you have talent and desire, and we want to create the kinds of opportunities that will allow working people to have a good job where they can be paid a living wage and live a secure life. And our message generally is that when you build a workforce that is ready, that is trained, that is skilled, that pulls the full talent of the American people, it's good for employers, it's good for our economy, and we see that time and time again in these jobs numbers.
Yeah. Getting back to the household survey, which is important to us and our viewers and listeners, the fact that it reflects agriculture, the fact that it reflects what's happening in people's households, does that not raise the level of importance of the household survey at this point when we look at that against payrolls to get a sense of not even as much where we are now, but where we're going?
I mean, I think the bigger, the answer is the payroll survey is the survey that tells us how many jobs have been created, what industries they've been created in. And again, the growth we're talking about is not just single industry, right? It has been for the entire time, but certainly this last month is no different, very, very broad-based. We saw growth in leisure and hospitality. We saw it in construction. We saw it in professional services. We saw it in healthcare. And so, there's really, the numbers don't lie. It's really, a broad-based, solid, continued growth. And I think that coveted soft landing that so many people bet against.
My conversation with Julie Su, the acting Secretary of Labor, a short time ago, was her first conversation coming off the data, actually. Really interesting to hear the way she framed some of the messaging coming out of the administration here. We're going to get a different side of this now with Catherine Edwards. I've been looking forward to this conversation with us today at the table. Economic policy consultant, adjunct economist at the Rand Corporation, also writes for Bloomberg Opinion. So that means, Catherine, you get to say whatever you want. I can only imagine what it's like to be you. Soft landing is what the acting labor secretary said, and we've been asking her that is this it? She seems to be saying it out loud now. You know what? This is it. What comes after a soft landing? Or, in your view, are we going into a recession?
I looked at the jobs report this morning and couldn't help but think that we are on borrowed time. I don't know how much longer the labor market can stay strong with interest rates at the level that they're at now and just the amount of pressure that most families are under to make ends meet.
Prices have you concerned? What part of the economy? Because we see some areas of worry in the household survey versus the establishment survey, which is where I started with her. They want to talk about a big payrolls number, but you see a lot of other evidence under the hood.
I mean, I think what I'm worried about most is just on some level, the dissatisfaction that Americans are expressing with their current economic situation, the amount of price increases that they've had to bear over the past 2.5 years, but at the same time, the lack of relief for any of those price increases. Policy geared towards making it easier for families to get by. I mean, none of that's allowed right now because we have to wait for prices to come down on their own through falling consumer demand. So that means we don't really get to help consumers at all. I don't know how much longer that can last.
Well, then you wake up on a morning like this and you hear that expectations of an interest rate cut have been pushed back and maybe nothing at all this year, even as President Biden predicts one. What do you make of that? Do you think it's true?
I mean, you have better people to forecast what the Fed will do than me. I prefer to look at the labor market than the people down the street. But, I do wonder. We know what needs to happen for the Fed to cut rates because they think inflation has cooled sufficiently, right? We have all the little ducks that have to come into a row and price. We get one kind of price report or one kind of jobs report. It either gets too bad in the labor market or we get good news from prices, and then they're going to drop rates. And we are all waiting for that to happen and have been for some time. I think what is not clear to me is when does the Fed admit that maybe this policy isn't going to do anything else? That we are at the limit of what it can accomplish. Even Dallas President Logan said it's not clear it's going to do anything else. Now, she was very careful to say that doesn't mean she thinks that rates should be cut. But, when you're living in a moment real time, you don't have the ability to step back and say, are interest rates the best thing that we can do or the only thing that we can do to move the economy from basically this what we think is a soft landing where we've been for 6 months.
Well, what do you do coming out of clearly still noise from a pandemic? How do you get to the supply side if that's where you're going?
I think that expansion of the labor market is good at keeping certain prices low because we don't have to have wages be bid up too quickly, and increasing labor supply is going to be challenging when the largest generation is retiring. And we're coming off of a period of restricted immigration. But at the same time, the U.S. has never pursued an active labor supply policy. It's not as if Congress has ever sat down and said, how do we maximize the number of workers in the United States today?
Well, there's a big argument about the impact of immigration. It's been going on for a long time. It gets louder with new research from Standard Charter that you may have seen. And the numbers were remarkable, if true, that undocumented migrants made up for half the job growth in this country since October, that we could be looking at as many as 100 to 109,000 jobs a month, distorting payrolls. Do you see that falling? First of all, do you believe that? And if you do you see that falling in the wake of this executive order from the president?
I hadn't seen it, but it doesn't necessarily surprise me. Immigration is a very big part of our labor market. Around 1 in 5 people who live in this country were not born here, and we tend to treat them as almost a separate segment that aren't as good or maybe aren't as important to labor market policy as native-born workers, but they are here and they are working, and to act as if they need a separate policy as opposed to are integrated into our labor markets, is really putting a demographic imposition on something the labor market wouldn't make a distinction between.
Interesting. But if that is qualified here in the next couple of months, the Biden administration is acting to shrink the labor pool, you could say then, yes?
No.
Shortly expecting the Fed reverse repo operation.
The basis of the U.S. economy is that we have more people basically every month than we do the month before, and that the population is growing. And that
69 counterparties take $395 spot $462 billion at the Fed reverse repo operation.
Slower or faster. But no, I don't think it's necessarily good policy. I mean, similar to how I didn't think it was good policy to let child care subsidies expire when we knew that it was risking pushing more women out of the labor force. And we haven't seen that happen to the degree that it was predicted, but it's certainly not helping the U.S. workforce that child care costs families, on average, a quarter of their income.
Yeah. It's interesting. You remember this exchange between Elizabeth Warren and Jay Powell in one of their many standoffs in congressional hearings. We tune in just for these moments sometimes. And she was making the point that you keep hiking interest rates, you keep them higher for longer, you're going to destroy the job market. And he clapped back and said, what is better, to allow inflation to run out of control so families can afford nothing? What do you make of the balance that he's trying to find here?
All policies have trade-offs. That is the reality. There's never one winner of all we have to do is this and everything is okay and it doesn't have any consequences. There's always a trade-off to consider. And Powell's job is not to consider the trade-off for how Americans feel about economy and society, whether or not they think that their struggles are important to their government. And that is Warren's job, and that is elected officials' job. I mean,
it's also a Fed's job with a dual mandate, you could argue.
I mean, are they equal mandates?
Tell me.
I don't know. We have had unemployment below 4% for just over 2 years, ending this month, and that's the second time it's happened in almost 100 years. So it feels like maybe it's not quite equal of a mandate. I think there's a policy question that is very much, I write it down on a two-dimensional graph. Prices are going one way, the labor market is going one way, and here's my interest rate policy, and I just let it happen. But the world in which this takes place is a world in which families are struggling, and they hear news every day that corporations are not. Right? That we have record profits happening for companies, and that we all have to make sacrifices for the economy if you're a family, if you're a worker, if you're trying to buy a gallon of milk, but we don't see the Fortune 500 companies making those same sacrifices. And who builds economic recovery and who bears economic pain? Those are still.
Appreciate your view. Catherine, thank you for joining. Catherine Edwards from RAND, only on Bloomberg.
The top names at the Fed are on Bloomberg.
The way I look at it is, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced.
I do think that our new steady state is likely to be higher than what people have known over the last decade. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Go figure out how to get exposure to hyperscalers, which we think will be the biggest winner in what AI and data storage will do for the world.
This is Bloomberg.
Wednesday, the Fed decides.
What data is important?
What would it take to reintroduce the rate cut conversation?
It's the labor market cracking that's going to allow the Fed to really enact some of its easing.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Inflation is still too high, and the path forward is uncertain.
They believe that policy is sufficiently restrictive.
The Fed can only deal with the data that it has.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost of living.
The United States' ability to spend without constraint is not unlimited.
We're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We do need more innovation, more investment, single market and capital market union, and a relevant trade policy.
Bloomberg. Context changes everything.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. GameStop back up and running after a trading halt, and the stock now lower by 38%. The highly anticipated return of Keith Gill to YouTube failed to immediately deliver a boost to GameStop after the retailer unexpectedly released earnings, and a plan to sell up to 75 million additional shares sent the stock tumbling in the hours before the live stream report. But right now we do have GameStop shares once again trading now lower by 37.6%. Jobs Jobs Friday, and we've got stocks higher after a solid report this morning helped quell fears about an economic slowdown that could hurt corporate America, even if that means a potential delay in Federal Reserve rate cuts. Right now, the S&P is up 16, up 0.3%. Dow Industrials up 84, up 0.2%. NASDAQ higher now by 39 for the NASDAQ Composite Index, a gain right now of about 0.2%. 10-year 4.42%, with a 2-year that's yielding 4.86%. Spot gold down 2.8%, lower by $68 the ounce. 23.09. Going to be very interesting to see how gold finally closes today. Will it be above? Will it hold above 2,300? 23.09 right now on gold. Crude West Texas Intermediate up 0.2%, 75.69 a barrel. GameStop again down 36% right now. S&P up 18, up 0.3. Balance of Power continues now. Back we go to Washington once again. Your host, here he is, Joe Matthew.
Charlie Pellet, thank you so much, sir. Happy Friday and welcome to the threshold of the weekend, the Friday edition of Balance of Power on Bloomberg TV and radio, with our eyes still on Normandy. A day after we marked the 80th anniversary of the D-Day invasion, President Biden was back today at Pointe du Hoc, the same spot, as I read on the terminal, etched in the nation's political memory in 1984. That's when Ronald Reagan stood in that same spot delivering his famous Boys of Pointe du Hoc speech, drawing common cause between their feet in the face of Nazi Germany's tyranny, to then the Cold War, and now today Joe Biden connecting the dots to aggression from Vladimir Putin, referring as well to Donald Trump without mentioning his name over the past 2 days. We assemble our panel for their take on this. Jeannie Shanzino is with us, Bloomberg Politics contributor, of course, senior democracy fellow at the Center for the Study of the Presidency and Congress. Matt Gorman is here too, Republican strategist and executive VP at Targeted Victory. Great to have you both here. Matt, what's it like as a Republican to hear the Democratic president channel the former Republican president Ronald Reagan, who so many Republicans cite in their arguments and their justifications for policies? A lot of folks have seen the Republican Party move away from that establishment view to one closer to isolationism. What did you make of Joe Biden's speech today?
Couple things. I don't think it was a very smart political ploy to raise expectations galactically before the speech and say that your speech today will evoke comparisons of, I believe, one of the greatest speeches of one of the greatest communicators we've ever had in the presidency. I think it did Biden a disservice to raise the bar that high. Number one. Number two, look, I revere Reagan. I do. I think he was one of the greatest presidents, especially of the 20th century. But I think what's tough, and we talked about this earlier, when you're trying to appeal to younger voters, invoking a president who gave a speech that is further away from present day than when he gave it to D-Day. It was a long time ago. And so it's tough to resonate when you're comparing yourself to a figure that many folks don't have that historical touch point for.
Boy, that's incredible. Great perspective on the timeline there, Jeannie. We talked about this a bit yesterday. There was more, of course, than Ronald Reagan. You might have seen this, by the way, or heard this as a very different speech. Was the White House correct to kind of frame it that way to begin with, to Matt's point, raise expectations?
No, absolutely not. Listen, Joe, I may want to, repeat Mary Lou Retton's Vault or something, but, well, I couldn't do it either way. But why would you set yourself up for that? Listen, Ronald Reagan's speech was given at a particular place in a particular time, and it was such a different media environment that a speech like that could raise your numbers and help you win the presidency, again, as it did with Ronald Reagan. But we're in a very different media environment, and you don't want to set yourself up for a repeat because, of course, all you can do is fall short in people's eyes. Was it a good speech? Absolutely. It was fine. The message is right. The time is incredibly different. So for that reason, I think, the White House, I'm a bit surprised. I think some of the speechwriters are so keen on getting their important words heard that they raise these expectations. But It's problematic. The reality is, if Joe Biden wants to win this election, he's going to have to return to the issues people care about. He is trying. This is an important issue. Democracy around the world is under attack. We've known that for 2 decades. He's trying to make that case. But what is it at home? It's all about the economy. It's all about inflation, the things you just talked to Julie Sue about. That's what it's about, and he's going to have to return here to win the election. So, good speech, absolutely. Is it going to change the ball game? Absolutely not.
Mm-hmm. Well, I don't know, Matt. I think that moment when he put the aviators on while he was still at the podium before walking away might have done more for young people than the words that he delivered in some cases. But how about the actions made? $225 million in aid announced for Ukraine in a bilateral meeting with President Zelensky. They appeared together. They got the footage of them talking and meeting. Joe Biden even apologized to him for the delay in funding. Is that closer to what the commander-in-chief should be doing here as he's running for re-election?
In theory, yes. I mean, look, he is governing right now. And look, there is certainly parts of the Republican base that do not want Ukraine funding. The worldview is very different. But also, it is broadly popular with independents and a large segment of Republicans. My old boss, Tim Scott, was supportive of funding for Ukraine in order to degrade the Russian military. And look, I will say, in his interview yesterday with David Muir of ABC News, Biden did make a good point. He did point out how much the Russian military has been degraded and the casualties suffered upon the Russian military. But I will say, I think to Jeannie's point, Ukraine and democracy writ large will not be winning issues for Biden on this election. If he wins this election, it's going to be because he was able to find a message on the economy and that abortion was able to at least match the salience that immigration does as a single issue motivating kind of point for voters. That's, I think, it's going to come down to at the end of the day.
It's interesting that we're still talking about money for Ukraine, Jeannie, after this massive supplemental request was passed. The president signed it into law. This $225 million shipment is actually a drawdown on U.S. supplies. As Ukraine waits for help here, it's going to take a long time to get some of that material to Ukraine. The meeting today important in helping that happen. Our European allies are also taking part in this now, and we're allowing Ukraine to use U.S.-made weapons, at least in some cases, near Kharkiv across the border against Russia. How long do you give the administration to widen that scope, even as they had warned over escalating this conflict with Russia?
Yeah, it seems to be a pattern with this war for the last 3 years. There is an ask, there is a time, and then there is an approval. I think the real challenge here for the White House and for all of us, quite frankly, and for Ukraine, is it is still very unclear, at least in my mind, what is the end game here? What is success? How do you define that? And of course, Zelensky defines it in one way that the White House, at least heretofore, has not approved or agreed with. And until we know what the end game is, we are down a path where this thing is just going to stretch out. So Joe Biden may revisit allowing, U.S. Arms to be used in Russia in a more concerted way. But is that going to make a difference? I don't think so. And I think as it pertains to this issue at home, the Biden team is better off, leaving this to people like McConnell and Sullivan. The Republicans in the Senate did approve finally the spending, and we saw McConnell's editorial. I think that does more to speak to these middle, moderate, swing Republican voters who aren't that excited about Donald Trump in general, but specifically foreign policy wise and the isolationism, to bring them over. And so the Biden team has tried to reach out, and they continue to do that. But they're far better having Republicans reach out to Republicans than trying to have Joe Biden over there doing it. And I'm not saying that was the intent of the speech, but from a domestic standpoint, it's not going to have a lot of impact, within 24, 48 hours from where we are now.
Mm-hmm. Matt, the Daily Mail is reporting that, of all people, Steven Spielberg, who we saw in the crowd yesterday at the Normandy commemoration, helped to prepare Joe Biden for his speech today at Pointe du Hoc. He was in the room at the Hotel Intercontinental in Paris on Friday morning when the president was doing his final run-through, doing prep here for the speech on democracy. The White House did not apparently respond to inquiries about this, but what does that tell you about the optics the president's trying to employ here?
You know, there's always this fascination, mutual fascination, Hollywood with politics, politics with Hollywood. You know, Biden has done this before. He's brought in John Meacham to kind of ghostwrite, if you will, or at least advise a lot of his speeches. Look, I love, you know, what Steven Spielberg did with Saving Private Ryan, producing Band of Brothers. He does bring a unique perspective to this, but I'm also, he's not much of a writer. So he's a director, so he can maybe advise in the cinematography, if you will, the scene that they're going to set. But at the end of the day, it doesn't really, I don't think, add much value to what Biden is doing. He's going to have to go up there and perform like he did today.
It's great to have both of you with us. A great panel on a Friday. Jeannie Shanzano, of course, Bloomberg Politics contributor and Republican strategist, Matt Gorman from Targeted Victory. We thank you both. Have a great weekend. We'll pull them back together again on Monday here on the fastest show in politics. Coming up, our conversation with David Weston, the host, of course, of Bloomberg Wall Street Week, after we get an update on world and national news. Amy Morris has that in the Bloomberg 99.1 newsroom in Washington. Hi, Amy.
Hi, Joe. The prosecution rested its case against the president's son, Hunter Biden. He's accused of lying on a federal gun purchase form when he said he was not using drugs at the time that he bought a revolver in 2018. Prosecutors say Hunter Biden was actively using drugs and that he lied on that form. They even called his ex-wife and a former girlfriend to testify that his drug use was habitual. Attention now shifts to lawyers for the defense team and whether they'll call Hunter Biden himself to testify. President Biden is apologizing to Ukraine President Volodymyr Zelensky for the 6-month delay in military aid. With that apology, about $225 million, part of the $61 billion that was held up by political fighting in Congress. That allowed Russia to make gains on the battlefield. Volodymyr Zelensky was grateful to have his military revitalized and says he hopes an end to the war comes soon.
I hope that it will be a first step on this way to peace. We need peace in Ukraine.
The funding will be used to restore the country's damaged power grid. The U.S. has reestablished a temporary aid relief pier to get deliveries into Gaza. That pier was damaged by storms and high seas about a week after deliveries first started. Central Command says they'll ramp up operations soon. They want to get about 1 million pounds of food every couple of days into Gaza. Global news 24 hours a day, whenever you want it, with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Arch has laid plenty of groundwork for future revenue. But for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Good morning from our world headquarters in New York. I'm Menace Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ all pushing higher. S&P very close to session highs. Stocks are climbing as that solid jobs report this morning boosts the earnings outlook. S&P up 14. Gain right now of 0.3%. Dow Industrials up 75, up 0.2. NASDAQ up 33, up 0.2. 10-year 4.41%. 2-year 4.86%. GameStop up and running. Stock lower by 39%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you, and welcome to the Friday edition of Balance of Power. It's good to have you on Bloomberg TV and radio. I'm Joe Matthew in Washington as we digest the data. It's Jobs Day here, of course, as Charlie reminds us, the market's reacting. So what you could look at is a mixed report. We talked to Molly Smith about it. We talked to the acting labor secretary about it. What should we be looking at? The jump in payrolls hotter than expected, or signs of deterioration possibly in the household survey? Not that that's a new question. Just ask David Weston, the host of Bloomberg Wall Street Week, and our colleague in New York is with us right now. The everlasting question, David, I won't ask you about 2%, but I wonder which has your attention today.
Well, I must say, politically, as I looked at those numbers, which actually did surprise me a bit, I think President Biden keeps getting the right answer to the wrong question. In the sense that, boy, people are getting jobs, which has got to be good. Wages are going up, which has got to be good, right? The economy's really strong, which has got to be good. But people are concerned about inflation, how much they're paying for things. And this doesn't help them on that score at all. I feel a little badly for them because I say these should be good answers, but I'm not sure they're answers to what people are really pressing about right now.
Yeah, and it's easy to write a statement, I suppose, if you're in the White House communications office talking about a stronger than expected jobs market. You just keep beating the drum, but the investment community, the markets look at this a lot differently. Are we wiping out chances for a rate cut this year?
Well, I don't know about wiping out. I mean, there are some who have been skeptical all around. Certainly reducing chances and reducing the number of rate cuts. And again, coming back to the political side of it, which is your bailiwick, Joe, I mean, if people are trying to get relief from higher interest rates, these numbers don't particularly point in that direction. I mean, it's not only that they're paying more at the pump and paying more for groceries, but also they're paying more on their mortgages. And by the way, on credit card debt and auto debt and things like that a lot of working Americans are feeling day in and day out.
We got an interesting conversation today that we're going to bring to our listeners and viewers now with a prominent voice in the financial markets and his view on this economy today, David.
Yeah, Scott Bessent, who actually was Soros' chief investment officer at one point. Scott Bessent has got his own fund now. He's got his own company, but he's talked about a fair amount because he's a smart man. He knows things. But also, he talks to Donald Trump quite frequently, and his name has been kicked around, as you know, Joe, well, as a possible Treasury secretary. Who knows whether that might come to pass or not, but people are paying a lot of attention to Scott Bessent right now, Joe.
Yeah, it's interesting. We talk about a short list for a lot of things for a potential Trump administration, but it's hard to pinpoint the Trump economic philosophy. David, outside of, well, I guess tariffs and making permanent the 2017 tax cuts, what else is there?
Yeah, I think also it's fair to say, and Scott Bessent does talk about this, that President Trump, former President Trump, maybe future President Trump, doesn't like regulation much. You remember when he was president the first time?
Yes.
He had that rule about taking away more regulations than you put in. And he's been pretty outspoken on that front, which I think you could expect. He also tends to like a weaker dollar and lower interest rates. That's been his pattern in the past. Some people say it might have to do with his background as a prominent real estate developer, which is pretty common there. But you're right, Joe. The question is, how do we anticipate what's coming around this time? I think it's fair to say from stuff you and I have both seen, Joe, that in fact, this Donald Trump has done a lot more work, or at least had people around him do a lot more work on their plans than the first time. There have been people working on these things, and they have some ideas, I think.
Yeah. Well, so we did walk us into this conversation.
Yeah, sure. Well, we did get to talk to Scott Bessent earlier today, and this is basically what he had to say. He started out with sort of a zinger about Bidenomics.
Maybe a better alternative name is Bidenitis. You know, it's like an acute disease. You never know when it's going to be fatal. But look, Bidenomics is a return to central planning that was discredited in the 60s and 70s. We got the same kind of inflation through that. And I think that it depends on this incredible level of government spending, state intervention, and kind of a disregard for markets. It's kind of the opposite of what Trump 1.0 was, which was private sector solutions. The other thing that is part of Bidenomics is you have this massive wave of government spending, but it's met by increased regulation, so you're constricting the supply side, and that's why you get inflation.
On the spending side, there's a lot of talk about the growth of government and objections to the growth of government. At the same time, you may know Ruchir Sharma has actually been writing on this subject saying, you know what, it has ever been thus, at least in modern history. Even the days of President Ronald Reagan, the government actually didn't shrink at all. It continued to grow during that period of time. Do you take issue with that? Do you think there was a time when the government actually was smaller and we had the results of it?
Well, David, I'm actually not an economist. I'm an economic historian, so I am boring enough that I could quote the size of government all the way back to Alexander Hamilton. So, there was a time when the government was smaller, and with good reason. A lot of the programs have been increased, but traditionally, in terms of revenues, tax intake as a percent of GDP in modern times, we've averaged about 17 to 19.5% of GDP. And I think that's a pretty good baseline level. But what's worrying here are the size of the deficits, which are being driven by spending. And I think that somehow this Biden promise that we will do better in 2025 is pretty disingenuous. That you spent 3-4 years spend, and then now there's no choice but to increase taxes. And I don't think they're going to cut back on spending, but in their 10-year projection, the only thing they do want to cut back on is defense spending. There's a 21% decrease in defense spending, which I find alarming, given the international environment that this administration's created, given what any administration, Democrat or Republican, is faced with the challenge of China, Russia, Iran, North Korea. Now Venezuela is getting in on the act. So I think decreasing defense spending is just the wrong way to go. And I would note that because of these blowout deficits, the inflation and the high interest rates, this will be the first year that interest service on the debt is higher than defense spending. And that tells me that this high debt is a national security issue.
As you say, Scott, we have something about almost a constant 17% of GDP actually in receipts. At the same time, expenditures, even during Ronald Reagan, there were 20%. They went up actually to 23 or 24%. They came back down close to 20%. The only time it's gone down as a percent of GDP was actually during Clinton. What do you think is a realistic number for a Trump 2.0? If President Trump gets elected again, what do you think is a realistic number for government expenditure as a percentage of GDP?
Look, I think we got to stay right in that 17.5 to 19% range, and I'm a big believer that for Trump 2.0, that we can control spending by freezing the discretionary component, except for defense, and moving toward a 3% deficit by 2028. I think that would be music to the market's ears. I think the debt market would respond to that. I think rates would go down. I think inflation would go down. So there's a chance here for a self-reinforcing cycle.
You mentioned regulation as being the other force that we'll have to contend with, and obviously President Trump does not like regulation. You've said we should have less regulation. But let me ask you about one specific form of regulation. That's antitrust regulation, because you've also expressed concerns about incumbency, as it's called. And we do have growing concentration, pretty much as I understand it, through the U.S. economy. Isn't antitrust a useful mechanism, and is it something that perhaps President Trump, a second President Trump, would use to try to reduce concentration, which, after all, would likely reduce costs?
Well, look, I think antitrust is a last resort. I think the real problem is we have too many barriers to entry. So once you cut regulation and there's more local finance available, I'm a big proponent of local and community banks, and Main Street can flourish along with Wall Street. And what really drives Main Street are these local banking institutions. But I think once you cut regulation, then you get more entrance into the economy. And I think the antitrust is a final solution. It's the draconian solution because you have priced out the startups. In my hometown of Charleston, South Carolina, we have a couple of new startup airlines, and the rates, the prices are low, the destinations are new, and it's pretty exciting.
So ECB's Lagarde says there's still a long way to go until inflation is defeated, and made major progress, but the inflation fight is not over. The path to 2% inflation won't be entirely a smooth ride. Lagarde says the ECB still needs to have a foot on the brake for a while, and we need to be vigilant and committed and persevere.
I think the original sin here with the Biden administration,
Lagarde says rates are to remain restrictive as long as necessary.
Was politicizing the Fed. So Jay Powell's appointment was the latest appointment this century for a Fed chair. They did not announce his reappointment until November 2021. When in August of 2021, if you go back and read the notes of the Jackson Hole meeting, his speech, he clearly knew that inflation was on the rise. He expressed concern about inflationary pressures, but because President Biden did not announce his reappointment until January. He was reluctant to do anything, and then the first hike wasn't until March. So look, Fed independence is very important. I think it's a personnel issue. I think Donald Trump is always going to make his opinion known. And I will note, in hindsight, when he was complaining about the high rates in December of 2018 and that Jay Powell was making a mistake raising rates, that he did a final rate hike in December, crashed the markets.
Noting some strength in the euro after that.
The head of the New York Fed had to come out the next day and calm things down. And then within several months, there were 3 rate cuts after that. Fall of 2019, when Donald Trump was complaining about high rates, we had the repo market blow out, and the Fed had to put in a standing repo facility. So, President Biden mentioned rate cuts in the State of the Union. He's mentioned them twice since then. So, jawboning is fine. Senator Warren likes to jawbone, and I think it's her right to talk about lower rates. And I think as long as it's in a public forum, that it's healthy.
And finally, Scott, you mentioned personnel are really important. Let's talk about personnel. Your name has been mentioned as a possible Treasury Secretary. You said you have a full-time job, I know, although I don't think you've said you wouldn't take it. But apart from individuals, in talking with President Trump, advising President Trump, what sorts of people would you advise he attract for his economic team? And how important is it to send reassurance to the markets?
Well, I'll take the last question first. Reassurance to the market is going to be very important, and I think that he would like to contrast with the Biden cabinet, because if you look at the Biden cabinet now, even the head of the Small Business Administration, I think, has been mostly in government work for the past decade or so. The Biden cabinet is lawyers, it's politicians, it's regulators, it's full-time government people. Like there's this saying that they've never signed the front of the paycheck. And I would say they've probably never gotten a paycheck. That they've been in big government, and they just get it through direct deposits. So I think a much better blend of private sector expertise coupled with people who have experience in government would be an ideal cabinet.
Fascinating conversation with Scott Besson, the CEO, Chief Investment Officer at Keyscore Capital Management, talking with Bloomberg's David Weston, who you can watch a little bit later on and listen to here on Bloomberg TV and radio on Bloomberg Wall Street Week. That's 6 p.m. Washington time. We're going to continue our conversation about today's jobs data in the late edition of Balance of Power. That starts at 5 o'clock Washington time. Heather Boucher of the White House Council of Economic Advisors will be with us. Up next, it's Bloomberg Business Week with Tim Stenevec and Emily Grafeo today as we work our way into the weekend. Thanks for being with us and spending some time with us. Don't forget to subscribe to the podcast here on Balance of Power, the fastest show in politics. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well,
That started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
The top names at the Fed are on Bloomberg.
The way I look at it is, you know, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced.
I do think that our new steady state is likely to be higher than what people have known over the last decade. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
A very good afternoon on this Jobs Friday, everyone. Live on Bloomberg TV, radio, YouTube, and Bloomberg Originals. It is Bloomberg Business Week. I'm Tim Stenevec, along with Bloomberg News cross-asset reporter Emily Graffeo, who's in for Carol Masser on this Jobs Friday. Emily, thanks for joining us. How are you?
Thank you for having me.
Yeah, good to have you with us. Hey, like I said, jobs, jobs, jobs. That is what everybody's talking about. The quote-unquote Fed unfriendly payrolls report heard around the street. Non-farm payrolls advancing 272,000 last month, beating all projections in a Bloomberg survey economists. That is up ahead. Stocks higher, but the bond market getting hammered after that hotter than expected jobs report. We've got a great roundtable on the rates reset, what it means for the Fed meeting next week, and what it means for the equity trade.
And the view of the jobs market when it comes to one of the world's largest temporary staffing agencies. We check in with a senior vice president over at Adecco.
Okay, everybody's talking about this on Twitter, so we got to hit it a little bit. GameStop shares, they are tumbling further today during the highly anticipated return of Keith Gill, a.k.a. Roaring Kitty. He went back to YouTube. There's also some fundamental news driving the stock lower, though, and we're going to discuss that.
And one more thing, we'll tell you about the best thing to do in the Hamptons this summer.
All that and more over the next hour on Bloomberg Business Week. First up, though, a check on the day's trade and top business stories. Here's Charlie Pellet.
Hi, thank you very much. Jobs Friday. We love it here at Bloomberg. The Dow, the S&P, NASDAQ, very much in the green right now. 7-point advance on the S&P, 5360, up right now by about 0.1%. We got the Dow up 42 now, up 0.1%. NASDAQ little changed, up right now by just about 2 points. We are on track for a winning week for the S&P 500 index. 10-year yield 4.42% with a 2-year yielding 4.87%. Spot gold hit hard today, down 2.9%, tumbling $69 the ounce to $23.06. And West Texas Intermediate crude up 0.1%, 75.64 right now for a barrel of WTI. Bottom line here, stocks higher after that solid jobs report helped quell fears about an economic slowdown that could hurt corporate America, even if that means a potential delay in Federal Reserve rate cuts. Our Michael McKee's going to have a whole lot more on the jobs report and the Fed coming up in just a moment. Cannot ignore GameStop. Roaring Kitty is back, but the stock is tumbling. GameStop now lower by 40%. Also, the video game retailer unexpectedly releasing earnings and a plan to sell up to 75 million additional shares earlier in the day. AMC Entertainment, by the way, now lower by 14.3%. Recapping, NASDAQ just turning negative, down 4 points. S&P up 6, a gain there of 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thank you so much for that update, Charlie Pellet. I certainly do appreciate it. Well, again, back to our top story on the day today, that payrolls report that pretty much closes the door on a July rate cut from the Federal Reserve. Non-farm payrolls advancing 272,000 last month, beating all projections in a Bloomberg survey of economists. Average hourly earnings climbing 0.4% from April and 4.1% from a year ago, both picking up from the prior report. Acting Labor Secretary Julie Su spoke to Bloomberg's Joe Matthew on Friday after the report came out.
Growth we're talking about is not just single industry, right? It has been for the entire time, but certainly this last month is no different, very, very broad-based. We saw growth in leisure and hospitality. We saw it in construction. We saw it in professional services. We saw it in healthcare. And so, there's really, the numbers don't lie. It's really, a broad-based, solid, continued growth. And I think that coveted soft landing that so many people bet against.
The numbers don't lie, and the bond market reaction certainly doesn't lie. We've got a great roundtable on the economic data, what it means for the Fed, what it means for rates. Treasuries, as I mentioned, getting hammered following that data release. So let's get to the interview. Michael McKee is Bloomberg News International Economics and Policy Correspondent. He's here in our studio. And from our Bloomberg Intelligence headquarters in Princeton, New Jersey, Ira Jersey, Chief U.S. Interest Rate Strategist. Mike, I want to start with you because I heard you covering this live on Bloomberg Surveillance. I believe the phrase you used was, we got a little bit more than we expected in the most recent report. How did everyone get this wrong? Why such an upside surprise, especially given the softer data that we saw earlier this week?
Well, it's a combination of things. I think the softer data is part of it, especially the ISM numbers. It came in weak in the employment numbers, but we'd also seen some weakness in retail sales and spending. And the narrative developed that the economy was slowing. And it still may be, but that fed into forecasts. And we saw 175,000 last month in the initial print. People said it's not going to be a whole lot different from that because everything else is telling us it's about the same. And we were all wrong.
Can you help us understand this higher unemployment rate to 4%? How do you square that with then the hotter than expected jobs report, payroll number?
Well, you can because the labor force grew significantly, over 200,000. But the real question is within that, the number of people who were reported unemployed, or rather employed, in the household survey fell by 480,000. And that confuses people because it's a difference between them and the establishment survey. And people really don't know why that is. The establishment surveys has a lot more participants than the household survey. The household survey does not include, or at least as far as we know, likely does not include all these immigrants coming into the country. If they're there illegally, they don't want to admit that they're working. And companies just report whoever's on the payroll. They don't report their nationality or background. And so there are a number of different possibilities for what's going on. At some point, the numbers will kind of reconcile, but right now we don't know. But the general view of economists is look at the establishment number, not the household number.
Okay, Ira Jersey, come on in here because the reaction in rates was certainly swift with yields up across the curve. How much of a reset is this for the bond market?
It's not a crazy reset because you're talking about going back to levels where we were about a week and a half ago. So it's basically returning to where we were before we got that soft ISM manufacturing number and some of the other weak data that we've received over the last week. I think for the long end of the yield curve, so you're talking about the 10-year bond, 30-year bond, I think yields are probably in a range here and probably will stay in a range until there's a very clear shift either upwards or downwards in economic momentum. A lot of the data data you saw, even though this was an upside surprise today, a lot of the data that you see is kind of just chopping around. It's okay economic news, and I think for that just means that the back end of the curve will just kind of chop around. The front end of the curve, so you're talking about 2-year notes and shorter term instruments that have something to do with the Fed, those can move around quite a lot because we're going to be pricing in and pricing out Fed cuts here and there every time we get these numbers. And basically, if you look at what we're priced now for 2025, we priced out almost an entire cut today for the cycle because of the strong data. So I think that's the market doesn't necessarily want to be short, but at the same time, it's hard to be long when you start to get this very interesting data that seems to suggest we're not going to go into a recession anytime soon.
Yeah, Ira, I wanted to talk a little bit more about that and just the sheer amount of volatility that we're still seeing in the bond market. This seemed like this was supposed to be the year of the bond, the time that portfolio managers are kind of using treasuries as almost a safe haven bet. How much of that has been upended, and how much of that are we seeing in the market today and in the last few weeks?
Well, I think a little bit. We haven't seen the massive differentiated flows out of risk assets and into treasuries. If you did, you'd probably see treasury yields a little bit lower, right? People buying treasuries just as a safe haven, like you said, especially given frothy valuations and some risk assets, even corporate credit, for example, with credit spreads as tight as they are, the equity market, at or approaching their all-time highs again. I think the thing with the bond market that people always forget is you go out and buy a 10-year, and if you're looking at that in a 1-year return or a 6-month return horizon, it can be very volatile. But if you buy something that's easier to hold to maturity, like a 2-year note or 3-year note at this point, the risk reward is more like owning a money market and locking in yields for longer than you can if you, say, go out and buy a treasury money market that has an average weighted maturity of around 60 days. You go and buy a 2-year note and you lock in 4.85% for the next 2 years. So there, you might give up a little bit of return in the near term, but you also have some certainty. And not only that, if interest rates would have to go to 10% for you to start losing money if you buy a 2-year note today. So the risk reward, I think, kind of favors shorter term debt because that 10-year, it goes up 20 basis points, and you're going to start to see your dollar price go down faster than the interest income that you get.
Hey, Mike, we heard Ira talk about rate cut expectations even into next year being changed after this report. But minutes after the data were released, Citi changed its first Fed rate cut from July to September. Later, we saw JP Morgan change its view from July to November. The big question, what does this mean for the Fed and for cuts, especially ahead of next week's meeting?
Well, they're not going to do anything in next week's meeting.
And they weren't, nobody thought they were going to do anything.
They weren't going to do anything. This leaves the question of what happens with the dot plot. How many dots do we get? We were 3 at the March meeting. Now, the question is it going to be 2 or is it going to be 1? And that's a very interesting open question that might be slightly influenced by the CPI report. But at this point, Jay Powell has, in the past, essentially stayed fairly dovish, talking about how inflation is going to come down and they're going to get there, and their base case is they can cut rates without putting a number on it. So maybe he influences too. But I think what we have all learned is that having a number doesn't mean it's going to happen. The Fed doesn't know what it's going to do. They'll put out 19 different forecasts, and then we'll pick a median and say that's what they're going to do. And it's kind of crazy, but traders got to trade. So
what are you watching for CPI, Mike?
CPI, we're watching real estate, housing. That's the big issue, because if you take real estate out of it and you measure U.S. Inflation the same way they do in Europe, then we have roughly 2% inflation. We're sort of there. So the Fed needs to see real estate coming down is one big thing. One interesting note, just crossing the wire here, we have breaking news for you guys. I bring you breaking news. The BLS has just announced it's going to cut the size of the household survey, which we were just talking about may not be accurate, starting in 2025 because they don't have enough money. to do the same size survey as they had. So this is not going to be a good thing.
So the results may be less representative, Mike, of what the economy looks like as a result?
Just raises the possibility that the survey will be off. They also, well, according to the BLS commissioner, she said today there's a real risk of a decline in quality, especially as response rates have also declined substantially.
Okay, one to watch, certainly. Ira, before we let you go, give us your catalyst for the next move that we could see in the rates market.
Yeah, well, it's got to be CPI and or the Fed, right? That's the next obvious one. I think after that, it's going to be probably more like retail sales, because if you think about the long-term growth prospects of the U.S., it's a propensity for the consumer to continue to spend money, right? And that's one reason why today's payroll report was important, not only because it created a lot of jobs, but you saw the wage data was very good, and you mentioned that at the top of the segment. So I think the retail sales data is going to be interesting. And I think 10-year yields, if that's really good, can wind up seeing 4.5% to 4.6% pretty quickly.
A big thank you to both of you for joining us. Michael McKee, Bloomberg News International Economics and Policy Correspondent. Also Ira Jersey, Chief U.S. Interest Rate Strategist. Ira joining us from Princeton. Michael McKee here in the Bloomberg studio. Now to the equity market reaction, which I would say is a little confusing. We did see stocks higher, and just moments ago they did turn negative. We have with us Christina Kino, Managing Editor for Bloomberg's Markets Live blog. She joins us here in the Bloomberg studio. So we did see equities higher until just moments ago, off the back of this jobs report. How has the narrative shifted just in the last few minutes?
Well, Tim, I think there is a lot of concern. The fact that there seems to be a lot of positive momentum in the stock market at the moment, also equally raising the concern from some people that perhaps it's getting a little bit too hot too quickly, right? And so we are bound to see some kind of pullbacks that we're seeing as of today, for instance, that kind of like intraday pullback and the stock market losing steam a little bit. But overwhelmingly, though, it does seem like the momentum is still very much positive. There's still a lot of optimism that we can see higher highs in the stock market, and we are about to enter that kind of peak optimism summer period, the best 2 trading weeks for the S&P 500 here, which is the first 2 weeks of July.
Yeah, like you said, today a little bit of volatility, but when you look at the week, the S&P 500 is still up about 1.3%, and that's coming after just week after week of green. How much is this a rally that's just going too fast, too soon, and how much of this can actually, stay for a while?
Well, it depends who you ask, Emily. But, if we're asking kind of the skeptics out there, they really are arguing. Just when you look at the level of valuations at the moment, and again, the pace at which we've seen these increases to more than 25 record highs for the S&P 500 just this year alone, it seems like it should be losing steam sometime soon. But at the same time, you see the likes of NVIDIA reaching $3 trillion in market cap. I mean, there is an increasing dependence and concentration on the mega tech companies really driving these gains. And some of the skeptics are saying that can't be going on for forever. But so far, it hasn't really shown any signs of losing steam. And that's what the stock market is really going off on.
Christine, back to the reaction to today's payrolls number. I was actually really surprised that we didn't see a bigger reaction to the downside for equities, given the timing of rate cuts is being pushed back more. Why do you think that is? Why do you think that it was such a muted reaction?
Yeah, really interesting question, Tim. I mean, we were asking about this earlier this week on the blog because, again, we were kind of looking at the possibility of 2 rate cuts this year from the Fed, right? Especially after we saw that soft ISM manufacturing data and a little bit of softness from the JOLTS data as well. But I think now the narrative has shifted from bad economic news being good for the stock market to good economic news being good for the stock market.
Hold on.
It's all good, Tim.
It's all good.
It's all good.
Is it though? I mean, when you have these discount cash flow analyses and you put in what you think rates are going to be, and if that changes, then what you're going to get as a return on free cash flow certainly changes moving forward, and that should bring equity markets lower. That should bring the price of a stock lower.
Yeah, absolutely. I mean, just when you think about it in terms of the level of interest rates at the moment and the cost of borrowing, right? It can't be sustainable for companies to kind of see it being this high for much longer. And that is the expectation among some of the stock skeptics out there, that at some point, higher for longer rates will have to bite for a lot of companies. But at the same time, I think there is this narrative that's kind of pushing forward, at least for today, that people are hanging on to, where maybe if the Fed, if markets don't think that the Fed will need to cut more than once this year, maybe the U.S. economy is really just that strong and it can power stocks even further.
Oh, we only have about a minute left, but talk about NVIDIA, because that stock has just been on a tear. And I know you've been writing a lot about it, Christine.
Absolutely, Emily. Again, $3 trillion in terms of market cap. A lot of questions over how sustainable it can be, especially because NVIDIA is still very much dependent on the rest of the tech sector spending on AI, right? That really is kind of its bread and butter. And so the question for the next few quarters, especially when we see earnings in the second half of this year, can that spending really continue? And can the retail sector also get in on this boom before it's too late and recedes? I mean, we are seeing the stock split coming through in early June. That's happening right about now. And so, yeah, lots of questions for NVIDIA for sure in the second half of this year. But so far, momentum looks to be very positive.
Shares of NVIDIA down just about 1% right now. $2.944.6 trillion is the market cap. A big thank you to Christine Aquino, managing editor for Bloomberg Markets Live blog here in our Bloomberg studio. Up next, a view of payrolls from the supply and demand side with the SVP of one of the largest staffing firms in the world. That's right after this on Bloomberg Business Week.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Go figure out how to get exposure to hyperscalers, which we think will be the biggest winner in what AI and data storage will do for the world.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Wednesday, the Fed decides.
What data is important? What would it take to reintroduce the rate cut conversation?
It's the labor market cracking that's going to allow the Fed to really enact some of its easing.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Inflation is still too high, and the path forward is uncertain.
They believe that policy is sufficiently restrictive. The Fed can only deal with the data that it has.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern. The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost of living.
The United States' ability to spend without constraint is not unlimited.
We're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We do need more innovation, more investment, single market and capital market union, and a relevant trade policy.
Bloomberg, context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. Major change for the U.S. stock market since our last update. Green across the board. Last time we checked, we were higher. Right now, the Dow, the S&P, NASDAQ 100 index, Russell 2000, all in the red. Little change to be sure. S&P down a point right now, down less than 0.1%. Dow Industrials down 1 point. We've got NASDAQ down 44, drop there of 0.3%. Strong U.S. payrolls and wage growth are pushing back bets for Fed rate cuts. 10-year, 4.42%. The 2-year, 4.86%. Right now, we've got gold, spot gold down 3%, tumbling $70 the ounce to $23.04. And West Texas Intermediate crude flat on the day, $75.52 a barrel. GameStop shares roaring lower right now, down 40.1%. GameStop tumbled during the highly anticipated return of Keith Gill to YouTube. He's roaring kitty after the video game retailer unexpectedly released earnings and a plan to sell up to 75 million additional shares earlier in the day. Again, we do have GameStop down now by 40%. Among other meme names, AMC Entertainment down now by 15.5%. So again, recapping, Dow Industrials unchanged on the day right now. S&P lower, little change, down by 1 point. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks so much, Charlie. Certainly do appreciate that. Well, we continue with our top story, the May payrolls report coming in way above estimates, beating all projections in that Bloomberg survey of economists, pushing back bets for Fed rate cuts as well. For review from the demand side of labor and the supply side as well, we bring in Amy Glazer, a senior vice president at the global staffing firm Adecco. It's one of the largest human resources providers in the world. Amy joining us from Jacksonville, Florida this afternoon. Amy, did this catch you by surprise the way it caught so many economists by surprise today?
Hi, Tim. Thanks for having me. And not really. It reflects and mirrors what we're seeing. Jobs are still available and candidates are still seeking. So the positive news, I think, is reflected the last time we spoke. You commented on my optimism, and I still remain glass half full.
And what exactly is driving your optimism and the strength in the labor market right now?
I think a couple different things. We still continue and will continue to see increases in healthcare. You know, we have the peak 65 phenomenon, 12,000 people retiring every day, the aging demographic. Healthcare is going to continue to be robust. This time of year, we're seeing seasonal hiring as it relates to hospitality, as travel's at all-time highs, and we're starting to see students enter the market. One of the interesting trends we're seeing regarding students right now is we're seeing normally they take the lifeguard or fast food jobs. This year, we're seeing them take an interest in some more skilled positions. So looking at technician roles and even manufacturing, and that's something we haven't seen in the past.
Why do you think that's happening? Is that because there's such a shortage of those folks who are in the trades right now? Such demand for those jobs?
I think a couple different things. There's huge demand. Pay is great in those areas, and stability is something that everyone's looking for today. So flexibility and stability are the two great winners.
All right,
do you think that's a permanent shift that we're going to see?
The stability piece, I think, will be around for the rest of this year. Flexibility will continue to become more and more important. The gig workforce is going to outpace the full-time workforce by 2027.
Wow.
So the employers that are embracing flexibility are the ones getting it right today.
That's really interesting. I'm wondering, kind of in a different vein, when you look at class of 2024, college students, where are those people looking in the labor force for employment?
Tech sector's hot. They're still looking in the retail sector. You still see interest in hospitality. Those things that they know are going to be sustainable for the upcoming years. But healthcare is really where it's at right now. And we're seeing lower barriers to entry. So we talk about the class of 2024, but you've also got to think there are jobs in the healthcare industry that don't require a 4-year degree. So you can get a 2-year tech certification. for example, or a 1-year certification and still enter that industry that's going to be booming. And it's often an entry path into a greater career.
You know, Amy, one of your notes caught my eye. You said that many workers are staying with their employers longer. What explains that? That's kind of interesting.
We talked about the Great Resignation 2 years ago, and now we're talking about the Great Stay. It's really that quest for stability. And I think COVID forced employers to really think about their employees' well-being. And lots of employers have embraced that and given better benefits and made it more flexible and a greater opportunity for their workers. They're also upskilling and reskilling to ensure they can retain that talent and not have to start fresh.
Amy, where in your data are you not seeing strength? You mentioned strength in healthcare and other sectors as well, but where are you not seeing strength?
Almost all industries are up right now, so it's not necessarily in the industry, it's more in where we're seeing it from a geographic perspective. You kind of have to look geographically as well as by industry vertical. The hot ones we're all talking about. The others, warehouse, transportation, manufacturing, even technology, we're starting to see some slight trends upward. They're just not as gangbusters as healthcare and education.
I want to take a maybe 30,000 foot view here with you, Amy. We saw with the number this morning that economists were a little bit more pessimistic on the labor force, and it feels like the consensus feels that way as well. What would you tell those economists, traders who say that the labor market is not as strong as maybe the numbers appear?
Yeah, I think, we've talked about since COVID that the recovery post-COVID wasn't going to be linear, that it would be bumpy. There's some noise. I think there was definitely noise in the April jobs report. Weather has some impacts on it. But as somebody who's talking in front of clients and dealing with open orders all day, I can tell you the market is still resilient and strong.
So when we got that JOLTS data earlier this week that many extrapolated to say, okay, well, the labor market is weaker than expected, did you think to yourself, that's not at all what we're seeing? We disagree with that?
I wasn't expecting quite the surge we had this morning, but I knew we'd have a positive report today.
Do you think that this positivity will continue for the remainder of the year?
Absolutely, I do. There will probably be some noise towards the end of the year. It is an election year, so we'll, employers may be a little hesitant waiting on that outcome, but come January 1st, I think we'll still be in a strong, robust market.
What does that mean in terms of numbers, like 200,000 and above each month?
I'd say over the next couple months, yeah.
Wow.
I want to go back to the Gen Z class of 2024 intern season, because that's fun. What should employers be expecting with these, new workers, Gen Z? They're just entering the workforce. People say that generation is a little bit different. What have you learned in your work about what bosses can expect?
So we actually just started 6 new managers in training at Adecco in my Atlanta office, fresh out of college this week. And they are eager, they're hungry, they have brilliant ideas, they have a different perspective on things. So you're going to need to be able to embrace that sign of creativity and allow it to flow. And they really want a seat at the table and a voice in the room. So making sure you're prepping the other generations in your workforce on how to navigate through that will be important. And looking at their soft skills.
Why are we both laughing?
Well, it's just funny to think about preparing your employers to deal with a new generation. Like, what does that entail?
What does that entail, Amy? Like, what do other folks who've been working in the newsroom or in offices for a while need to understand about this generation?
Yeah, they want flexibility. They want their voice to be heard. They want to work on their time. And they're more about the output of their work versus the hours. So Gen X, baby boomers, we're used to a 9 to 5, and the harder we work and the more hours we put in really proves our value. And the Gen Z mentality is the product of their output of work is what's going to show their value. So if they can get this job done in 4 hours, they're happy with that.
They can go home or work from home, I'm guessing. That's where I want to go with flexibility. When you say flexibility, do you mean to say that employers who
NYMEX gasoline July futures settle at $2.38 a gallon. NYMEX natural gas July futures settle at $2.91. NYMEX
What we've
diesel
seen with this
July
workforce is that
futures at
hybrid is the best way to
$2.35
go.
a gallon.
They make connections faster. They get that sense of community, but
And
they still
NYMEX
have the
WTI crude
flexibility
July futures
to
settle at
go to the beach in the morning or
$75.53
whatever
a
it is they
barrel.
want
That's
to
down
do.
2
So
cents
they
or
can put in the morning.
0.03%.
What are we talking about?
Jacksonville, Florida. So that's a common theme.
This is
Before you log on, Tim.
This is so foreign to me, the idea on a weekday of going to the beach in the morning and then getting some work done. But I don't know, Emily, if that's working for the new generation. It's working.
Well, you know, if they don't start until 9 and you live near the beach and you can work out at 6 a.m., I could see a path perhaps in Jacksonville. Maybe let's switch to the older generation because, Amy, you also write that more Americans than ever will turn 65. How will that impact the workforce this year?
So it's impacting it quite significantly, especially in the skilled trades manufacturing, where a lot of legacy knowledge and skill and talent are choosing to retire. So we're seeing skills gaps, which we'll continue to see over the upcoming years. One of the big trends we're seeing, though, is the embracement of the return of the retiree. So right now, 1 in every 8 person that's retired is looking to return back into work. And this is giving some relief for companies that have really experienced that loss that COVID accelerated.
But there's the flip side of that is those retirees feel like they need to get back to work. That's troubling, no?
A couple different reasons. So some of them are motivated to get back for money, but oftentimes we see they're motivated to get back to providing that sense of purpose and community. My mom's a baby boomer and she volunteers because she misses that sense of community. So some are for economical reasons, obviously with inflation being what it's been, but oftentimes it's just about community and giving back.
Amy, before we let you go, did you already go to the beach today on this Friday Jobs Day, or?
Not yet.
Okay, not yet, but
Tomorrow.
maybe on the agenda.
On the weekend.
On the weekend. That's, in the old-fashioned way.
That's the old-fashioned
doing
way.
that
That's
stuff
what a
on
Gen
the
Xer would do, yes.
Exactly. Amy Glazer, Senior Vice President at Adecco, joining us from Jacksonville, Florida, on this Jobs Friday. Mixed market right now. The S&P 500 pretty much flat, but in the green, as is the Dow Jones Industrial Average. The NASDAQ Composite, though, down by 0.2% right now. Well, coming up next on Bloomberg Business Week, we get the latest on GameStop mania because that's one company that's seeing its shares actually move lower on the day today. And that highly anticipated live stream from Roy and Kitty did not help the situation at all. That's right after this. First up, though, a check on the latest world and national news. We got Amy Morris in the Bloomberg 99.1 Newsroom. Hey, Amy.
Hi, Tim. About $225 million in U.S. military aid making its way to Ukraine now. That delayed funding, blamed on the political infighting of the Congress, allowed Russia to make some gains on the battlefield. Ukraine's President Volodymyr Zelensky put aside his frustrations and made it clear that just like 80 years ago, this war cannot be won without the U.S.
Like it was during World War II, how the United States helped to save human lives, to save Europe, and we count on your continuing support and staying with us.
President Biden offered an apology to Ukraine's president for the 6-month wait while the two were attending D-Day commemorations in France. The U.S. military's temporary pier of Gaza's coast has been repaired. It's now reattached to the beach. This after the pier broke apart and sustained damage from heavy seas. U.S. Central Command Vice Admiral Brad Cooper said they do expect to continue the delivery of humanitarian aid within the next couple of days. Their goal is £1 million every 2 days. And federal prosecutors have rested their case against Hunter Biden, the president's son, in the federal gun trial. The trial is now adjourned for the weekend. The testimony from defense witnesses, including Naomi Biden, the daughter of the defendant. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. The world has very few experts in C++ and C, but the world has many people who knows how to converse and ask somebody for help. Instead of instruction-driven computing, it's now intention-driven computing.
You know, this AI opportunity is really tremendous. You have an ecosystem of companies coming together along with all these incredible innovations. It's causing a new industrial revolution.
This is a tsunami, Ed. This is a tsunami of change. And only the smart ones are going to recognize I have to plant the flag now.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
The top names at the Fed are on Bloomberg.
The way I look at it is, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced.
I do think that our new steady state is likely to be higher than what people have known over the last decade. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg. Top experts. Great questions.
It's 2:40 on Wall Street. We do check markets all day long at Bloomberg. Choppy session. We have got the Dow, the S&P. They are both higher. NASDAQ in the red, right to the numbers here with the S&P 500 index down 2 points right now. Jobs Friday, little change there. Has been swinging between gains and losses. The Dow up 34, higher by 0.1%. NASDAQ in the red now by 29 points, down by about 0.2%. 10-year 4.42% with a 2-year that's yielding 4.87%. Spot gold down $75 the ounce, 2,300 even right now on the precious metal. A drop right now of 3.2%. West Texas Intermediate crude down 0.2%, 75.41 for a barrel of WTI. GameStop shares tumbling further after the highly anticipated return of Keith Gill, Roaring Kitty, to YouTube, as well as the video game retailer unexpectedly releasing earnings and announcing plans to sell up to 75 million additional shares earlier in the day. GameStop now lower by 39.6%. Briefly after earnings, DocuSign shares, they are down now by 3.2%. The e-signature company forecast billings for the second quarter that did fall short of the average analyst estimate. So again, recapping here, S&P little changed right now. Volatile session, S&P up 3, a gain there of 0.1%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Hey, thanks so much for that, Charlie. Certainly do appreciate it. Shares of GameStop down close to 40% right now. They even fell during the highly anticipated return of Keith Gill to YouTube and after the company unexpectedly released earnings and a plan to sell up to 75 million additional shares earlier in the day. That's what sent shares lower to begin with. During the live stream, though, GameStop shares were halted 9 times. For more, we bring in Carmen Reinecke, Bloomberg News equities reporter. She joins us here in the studio. Carmen, you watched the live stream along with hundreds of thousands of other people, so we didn't have to. Thank you for doing that. Appreciate it. What did we miss?
Well, the first thing you missed was a very bizarre late appearance from Keith Gill. So the live stream was supposed to start at 12 p.m. We waited at least 25 minutes for anything to start. It was really anxiety-inducing. The comments on the live stream were going absolutely wild. People were like, where is he? What's going on? Finally, he did come to the screen. We saw a video with a lot of cats, very on brand for him. And then he showed up, with very long hair, Band-Aids, a sling, which we later learned, was not needed for his arm, and was sort of showing that, he's being shocked by the comments, shocked by the markets. And it was really interesting. It was just sort of a return to Roaring Kitty entertainment.
We're back. 2021 is back, Emily.
Well, I feel like he was brought to fame because at one point he did have a fundamental case for why he was buying shares of GameStop. Did he say anything that included any real fundamental analysis on the company?
He very briefly did speak about the fundamentals and then really kind of just kept going back to he was watching the stock, he was watching to see if it was halted, he was watching the comments, which really just rolled through the entire time. It was like rapid fire.
It was like hard to read them because they were moving so quickly.
Exactly. So there really just wasn't a lot of substance here. He even said at the top of the video stream that he really just had no plan. He brought out the magic 8-ball, and he ended it kind of early for him. It, only went on for 50 minutes.
Was there anything in here that you can sort of tell us that harkens back to the height of the meme stock craze of 2021? Does it feel like we're at a similar place? I mean, after all, we're talking about Roaring Kitty again, and shares are moving double digits because of positions that he's taking.
Yeah, so he did show his positions again. They seem to be unchanged from what we'd seen previously. So there's that transparency is sort of back. He sort of made some jokes about E-Trade, like don't make me sell this off, or sort of things like that.
Because of the reporting earlier this week from the Wall Street Journal that said that they were looking into his accounts.
Exactly,
okay.
Exactly. And I think that one thing that does feel like 2021 is the sort of enthusiasm for his return. Obviously, what maybe is not, it was the shares, they're still falling. They're down about 40%. That's maybe not what people had anticipated with his return to social media and speaking about GameStop. So it's, a little bit different this time.
What does the share sale mean in practice? And is that what's driving the stock lower today?
It really could be. We don't have any indication from GameStop that they are actually currently selling. They just announced this plan to sell shares. On one hand, people have said that it's very smart, savvy of them to be taking advantage of, running up in the stock price and, having these sales. But on the other hand, it can be dilutive for investors. So not everybody likes it. If you are holding GameStop shares, it's not necessarily great for your position to have the overall pie be getting larger. So that is something that could be sending shares down today.
Essentially, it's the opposite of a buyback. And what happens is that the company then can use that money for other things. We also got numbers from GameStop earlier today, and no earnings call, which is pretty typical for the company. What did we learn about GameStop with the little information that they do provide.
And crude
Yeah,
futures settled at
so-
$79.62
That
a barrel.
is very
That's down
typical for them.
25
They
cents or
showed that
0.31%.
slowing sales and a wider loss than expected. So not great, right? I mean, this isn't a company that people usually are actually looking at for its fundamentals, which is one of the reasons that it has become, so hyped on the meme scale. But yeah.
I want to kind of talk about the speculative fervor in the market because it's confusing. You see the stock down, but there were over 500,000 people watching the live stream, which is pretty incredible. We were joking with Mike McKee earlier that we think that might be more than the amount of people that watched Jay Powell's live stream during the FOMC. So what is your take, Carmen, on just the level of speculation and I guess animal spirits driving the market when you have, the stock down, but all of these people paying attention to what's going on?
Yeah, I mean, I think it really shows that the retail block is very important, that we're giving them a lot of weight, but it's because they can, and they've proven that they can move entire stocks, that they can squeeze things, that they, then they're not just moving GameStop. I mean, AMC is seeing similar sort of running up and down today alongside, the other meme names. So I think it just shows that people are kind of like, they're excited. They're sort of looking for maybe a return of the meme mania of 2021. And I mean, we'll see where it goes from here.
It seemed like Keith Gill, aka Roaring Kitty, had perhaps consulted an attorney before doing this live stream because there was some legalese in there.
Yeah, so he did update sort of like the disclosure saying that this is really opinion based, that people basically shouldn't be taking this as investment advice. And it was interesting because on the live stream, he did sort of make a few comments and looked like he was looking off the camera like someone else might be in the room with him. And someone did address a question, is there a lawyer there with you? And he said, there's not, maybe there should be. It's definitely something that people are watching, that, if there is market manipulation, if he's being more careful. He did also say a few times like, oh, can I say this? Is it okay? So yeah, I mean, it seems like even if there wasn't a lawyer in the room with him, he is attempting to be more cautious, or at least joking about being more cautious.
Have you ever talked to a portfolio manager who is bullish on meme stocks, or maybe not bullish and going long, but is actively trading them?
I haven't. I think the portfolio managers that I've all spoken to have said something along the lines of, we sort of have to watch it. You get questions about it. It's, not really my cup of tea. It's not something that I'm looking at. But, one person sort of likened it to like watching the Kardashians. It's the thing that's happening right now. It's interesting. It's fun. And people, they're following along.
In the Bloomberg terminal, we can look at ANR, analyst ratings. There are 0 buys on the stock. There is 1 hold, and there are 2 sells on the stock. So it's pretty thinly covered by analysts. But I think the difference is between this and watching the Kardashians is that people can lose and have lost serious money doing this stuff.
Yeah, totally. There is money on the line. And I mean, you have to remember that when you're going to play the market.
Yeah, that's a really good point. Hey, Carmen, thank you again for watching that live stream. And I'm kind of good news that it was under an hour, because those things can tend to last quite a bit of time. Carmen Reinecke is Bloomberg News equities reporter. She's joining us here in the Bloomberg studio. A mixed day on Wall Street right now on this Jobs Friday. The Dow up a little more than 0.1%. The S&P 500 up 0.1% right now. The NASDAQ Composite down 0.1%. Coming up next, maybe you haven't made those summer plans completely.
In 10 minutes' time now, at the top of the hour, see the release of the US consumer credit. Forecast 10 billion on the prior 6.27 billion.
In the Hamptons this summer. It requires getting on a boat. That's just a little hint of what's next on Bloomberg Business Week.
decided to acquire Indeed 12 years ago, when I was 36, I couldn't speak English. But I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the place to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
This is Bloomberg.
Now, your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. 2:53 right now on Wall Street, and a federal judge has ruled that Alphabet will face a bench trial instead of a jury in the Justice Department's antitrust case alleging monopolization of the advertising technology market after the company paid the federal government $2.3 million. Right now, we've got Alphabet shares trading lower by just about 0.2%. Bain Capital has agreed to buy education software provider PowerSchool Holdings in a $5.6 billion deal. Private equity firm is going to pay $22.80 a share in cash for the Folsom, California-based PowerSchool. PowerSchool shares, they're up right now, little changed, up by just about 0.1%. Rent the Runway shares moving lower after the consumer goods rental company reported first quarter revenue that slightly missed expectations. Investors are focused on that, with Rent the Runway now down by 11%. PIMCO is laying the groundwork for a potential brawl over the future of media company iHeartMedia. Sources say the investment firm is in the process of creating a breakaway group and has hired New York law firm Davis, Polk & Wardwell. iHeart emerged from Chapter 11 5 years ago and is facing a potential restructuring. Shares, they're up right now by about 13%. Porsche shareholders are calling on the luxury car maker to ease off of its electric vehicle push as a global slowdown for the technology threatens sales and profits. Today, we've got ADRs of Porsche trading lower by 1.7%. Tesla, meanwhile, up by 0.6%. Tesla shares now at $176.95. And those are some of our top company stories at this hour. I'm Charlie Pellet, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It is Bloomberg Business Week. I'm Tim Stenevec, and that's Emily Graffeo, Bloomberg News cross-asset reporter, in for Carol Masser on this Friday afternoon. Hey, let's go to Washington, D.C. now for a check the latest world and national news. We got Amy Morris in the Bloomberg 99.1 newsroom. Hey, Amy.
Hi, Tim. Secretary of State Antony Blinken is going back to the Middle East. Blinken is working to keep a ceasefire proposal between Israel and Hamas alive. He's going to meet with senior officials and will continue to push forward a plan that the Biden administration says would pause fighting and guarantee the release of Israeli hostages and set in motion the rebuilding of Gaza and a longer-term solution to the conflict. Next week's trip will be his 8th visit to the region since the war started. The United States has reestablished that temporary aid relief pier to get deliveries into Gaza. The pier was damaged by storms and high policies about a week after deliveries first started. Central Command says they'll ramp up operations soon. The goal is to get 1 million pounds of food and other supplies moving through that pier into Gaza every 2 days. Former President Donald Trump and his former chief of staff, Mark Meadows, and Trump 2020 Election Day Operations Director Michael Roman have pleaded not guilty in Phoenix to 9 felony charges for their roles in an effort to overturn Trump's election loss in Arizona to Joe Biden. The two men, that would be Mark Meadows and Michael
So in
Roman,
around 3 minutes'
appeared
time
by
now, get the
video
US
conference
consumer
for
credit
separate
at the top of the
hearings.
hour.
Now, the judge said
Forecast
on
10
October
billion
31st
on the
trial
price,
date, Meadows
6.27
and Roman are
billion.
accused of working with other Trump campaign members to submit names of fake electors to Congress. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and now back to Bloomberg Business Week with Tim Stenovic and Emily Griffeo.
Hey, thanks so much, Amy. Do appreciate that update. Well, as promised, we're going to tell you about the best thing to do in the Hamptons this summer, and it is, drumroll, tuna fishing, Emily. So how do you do it?
So this is not even a trip that has to take the whole weekend.
Yeah.
Now, with the dawn of blade helicopters, faster boats, larger tuna fish, Wall Street workers are flying out from New York on Friday and returning on Saturday with coolers full of tuna and sea bass. They go out to the Hamptons, they go on a chartered fishing trip, often out of Montauk, and then they eat the fish and then they come back to the city.
And Starlink is actually a big part of this because with Starlink internet service, you can actually do your work anywhere, at least according to the folks around Kate Crater talked to for the story. You mentioned, Emily, going out on maybe 4 a.m. on a Saturday morning, catching some tuna and coming back in. Well, one person who recently did this brought a few of those tuna to a local sushi chef who prepared it several different ways, and he was able to then go eat that tuna prepared many different ways.
It's funny because fishing has been around since the dawn of the human population. We've always been fishing, but the Bloomberg article today talks about how it's actually becoming more popular on the East Coast as big game fish are swimming closer to shore. Tuna, for one example, the fishers out in the Hamptons are seeing more tuna, so it's making for a more exciting fishing trip.
Yeah, Kate spoke to Chris Squarey, the co-owner of Atlantic Yacht Haven Marina over in Freeport, New York, and said that the profile of people signing up for a fishing competition is evolving.
There's 1 minute remaining now for the US consumer credit.
50% in the number of boats for the tournament over the last 5 years. Last year was 60 boats. This year, we're expecting 75 to 80. More Wall Street types, more hedge fund guys, along with Joe Fisherman.
Joe Fisherman. He's there too, guiding you along the way if you don't know what you're doing.
All right, so if you don't have your plans for the summer, you can go charter a boat in the Hamptons and do a day of tuna fishing. Hey, if you are sticking with us here on Bloomberg TV, coming up next, it is The Close. But if you're sticking with us on Bloomberg Radio for the next couple of hours, we got a great program, including Apple's biggest sales pitch in years. We're going to be joined by Mark Gurman, our chief technology correspondent, in just a few minutes for a preview of WWDC. It's Bloomberg Business Week, and this is Bloomberg.
10 seconds.
That sound you hear is the
Still
door
waiting.
closing on a July Fed rate cut. Live from Studio One here at Bloomberg headquarters in New York, I'm Romaine Bostic.
And I'm Bonnie Quinn. We're kicking you off to the closing bell right here in the United States. So let's get a check on where markets stand after that blowout jobs report. Well, blowout in many ways.
6.403 billion, 6.403 billion, lower than the forecast of 10 billion.
Or else they're just waiting to make their decisions next week. However, for the smaller cap stocks, we are seeing a decline of 1%. Huge apathy towards smaller cap stocks. Of course, higher rates, not great for those smaller businesses. Increasing job growth, you would think, would be good for those businesses. People have more money to spend, but that's not being reflected in valuations, in stock prices. And then the real move, right across the curve, we are seeing a move of about 12 to 14 basis points, Romaine. So we're headed right back up to that 5% on the 2-year, potentially.
A lot of activity in the Treasury market, and that had to do with the jobs report this morning. The pace of job creation in the U.S. really just blowing past all expectations. 272,000 new non-farm positions, and that was more than what every single one of the 77 economists in the Bloomberg survey had predicted. While the unemployment rate did edge up to 4%, wage growth doubled from April, reigniting inflation fears and prompting traders to pair expectations for the Federal Reserve's first interest rate cut. That's the setup heading into the Fed's two-day policy meeting next week, a meeting backdrop by today's jobs data and next Wednesday's Consumer Price Index report, data that will guide the central bank's quarterly update of economic and rate projections for the rest of the year and into 2025. Goldman and Nomura were among the big banks who already shifted their base case for a cut from July to September. Economists at Citigroup and JP Morgan today finally adjusting their outlook to the fall as well. And Mohamed El-Arian is telling Bloomberg Television that anyone expecting anything sooner is kidding themselves.
There's no way they can cut or signal a cut in July with this data. They would have to change their reaction function and be public about it, and I don't see the Fed doing this. So that's why the door is shut. There are no spare tires in this economy. So if you get it wrong and you weaken too quickly, it's going to be a very difficult mistake to correct.
That's the Fed's problem. This is investors' problem. And if you had been playing volatility and rates this year and you happen to get it right, boy, are you deserving of a huge bonus. Look at what we have seen. We were at 7 rate cuts potentially right before the beginning of the year. We've been up and down, up and down, up and down ever since, but basically coming down to 1, maybe 2 this year. That may be reflected next week in the FOMC meeting. We are anticipating that rates will stay at 5.25% to 5.5%. But where will that median dot be? That's the big question.
Yeah, it feels like the entire narrative all year long, Bonnie, has really all been about a shift in expectations from week to week, from day to day, and month to month. Charles Lemonides joining us right now. Always a constant presence for us here on The Close. ValueWorks founder and CIO. All right, you saw the numbers this morning. It was a blowout. Did it give you any sort of clarity about what the Fed is going to do next, or are we just still kind of in that same churn that we've been in for a good part of this year?
It did 2 things for us. One, it absolutely gives us clarity that the Fed is not tightening, not loosening anytime soon. Tightening maybe, but not loosening anytime soon. But the other thing it did for us in terms of clarity that's at least as important is give us increased confidence that the economy is growing with today's interest rate levels, so that we've adjusted to much more expensive money, and there's fundamental demand regardless of, that's not being driven by zero interest and free money. So what's driving the economy is the real investment opportunities that businesses are finding and the real demand for their products, and they're adding employees because there's work to be done, and that's even with Fed funds where they are. So, I don't think the Fed has a reason to change course, and I think that investors should be happy with the state of affairs.
And it's a great point, though, too, about corporate fundamentals. I mean, we're still talking about markets, at least for the S&P and NASDAQ, sitting at record highs, even today after that jobs report. And it gets to this idea that companies are still finding a way to make money, and ultimately, at least for investors, that's all that really matters.
That's right, and they're finding ways to grow their businesses. And yes, on the one hand, we're at all-time highs, that's true. But on the other hand, we're not that much higher than where we were 2 years ago. The markets have broadly paused, and over this past 2-year period, by a lot of measures, equities have become a lot cheaper than they were 2 years ago at the same level. So there's a lot of runway for upside from here.
There's so many cross currents, right, Charles? Because on the one hand, we're seeing all these AI stocks and companies that are using AI and beginning to buy chips and so on, really see a huge amount of enthusiasm from investors, and that would portend perhaps fewer jobs in some of those areas. And yet we're seeing an economy that's creating jobs, creating demand. How do you reconcile those 2 threads?
Well, there's a couple of things going on. One, the actual work of creating those AI networks, whether it's building out the data centers or creating the energy for them to use or building the chips, that's real work, and that's fueling economic growth. And the other thing that's happening is that there's a wealth effect that's going on. Huge wealth has been created in these investment opportunities, and that wealth isn't necessarily going to go away because the investment opportunities really are real for AI. I don't know what we're going to be doing with AI 5 years from now, but I'm sure it's going to be a big deal.
We are seeing unemployment at a 4 handle, but we did see a huge amount of job creation. What does a small business CFO decide to do with that information? Because on the one hand, there will be more demand from consumers for their products, presumably, if we can believe the data. On the other hand, there absolutely won't.
the biggest challenge for many businesses over the past couple of years has been to meet demand, and to meet demand without needing to raise prices and increase their costs. You're seeing that in industry after industry, and so that's a really good problem for them to have. And there aren't enough workers to fill all the jobs out there, but 4% unemployment is a little more room than 3.8.
I'd be remiss in not asking you about kind of the AI theme, the AI trade, and particularly for someone like you who is a value investor. I'm wondering, do you look at any of these AI names, whether it's NVIDIA or Microsoft, AMD, whatever, do you find any true value there as an investor, as an entry point at this stage?
In the four names that have captured everyone's imagination and enthusiasm over the past 6 months, 4 years, NVIDIA especially, no, you don't want to bet against it because of the momentum it carries, and the great business dynamics they have.
Yeah.
But it's a $3 trillion valuation. Explain to me how you're going to actually double your money in that investment in the next 5 years. That seems like a real stretch. But there are a lot of other companies that will benefit from the explosive use. And so we're in those names, and we try to build a diversified portfolio with that type of exposure. And our number one name there is Micron, because you need more memory chips to power this stuff. The cycle has inflected. They're going to be earning significant amounts of money next year and the year after and the year after if this boom carries on. So I think there are value ways to get at the AI boom. You just have to be thoughtful about how to do it.
Micron has had a huge run-up itself, so why pick Micron as opposed to another chip company, for example, Intel, or somebody else that seems to be making moves? And I also want to ask about your EV play, Rivian.
Well, Micron's had a big move, but it's $150 billion equity cap. It troughed at $75 billion equity cap. It's a double. But the real AI growth stories are triples and quadruples. And Micron is up modestly from its peak at the last cycle, but not by orders of multiple. And they're earning $9 next year and trading at $130. That's just not a tough stretch. And there are other chip names out there. We own Qualcomm. We think the valuation there is still good. But the chip stocks that haven't moved, for the most part, haven't moved for really good reasons. Their challenges in their business and their challenges in their competitive position is very real. So, there will be losers in the sector, and figuring out which ones where there's not a lot of good news that will turn out to have good news is really hard.
All right, Chuck, always great to talk to you.
Whoa, you missed Rivian.
Oh, Rivian. Look, Chuck, we're almost out of time here, so we got to go. We're going to get you back and talk Rivian. Charles Lemonades there over at Value Works, the deep tease there here. And any eagle-eyed viewers out there have probably noticed that we've actually been on a different set for the past couple of weeks. That's because we are constructing and relaunching the close. That kicks off on Monday, June 10th, and we really want you to join us because we are starting big. Apple co-founder Steve Wozniak going to be joining us. So too is the former IBM CEO Sam Palmisano, Bond King Bill Gross, Mercer's U.S. Chief Investment Officer, as well as former India Central Bank Chief Raghuram Rajan. All this huge lineup all week long. Be sure to join us right here on The Close on Bloomberg. That starts Monday at 3 p.m. with myself, Scarlett Fu, and Alex Steele. Meanwhile, our coverage continues here today. When we come back, a deeper dive into today's job report and an update from the White House. Gene Sperling, White House advisor, going to be joining us in just a second. Plus, we're also going to talk about what it means for federal rate policy with some insights from Nathan Sheets, global chief economist over at Citi. And as we count you down to the close, we're going to jump into all the market action with Jay Woods, chief global strategist at Freedom Capital Markets. Don't go anywhere. This is The Close on Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Go figure out how to get exposure to hyperscalers, which we think will be the biggest winner in what AI and data storage will do for the world.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is a really strong report.
Stronger than what people were expecting going in.
This jobs report is not recessionary. It is soft landing.
It does close the door on a July rate cut.
I think the Fed would still like to get a cut or two done.
There's no way they can cut or signal a cut in July with this data.
I still think September you target as doing that.
The reason we think the Fed is going to be able to cut in September and December is because we think that inflation is going to proceed with moderation.
At least as it pertains to equities, I think the Fed pushing out when they're cutting is good news.
There are no spare tires in this economy. So if you get it wrong, and you weaken too quickly, it's going to be a very difficult mistake to correct.
The view from Wall Street on today's big blowout jobs report that we got earlier today. Stronger than expected U.S. jobs, 272,000 created. But once again, it is a tale of two reports. Let's get some insights from the Biden administration directly. Gene Sperling, White House American Rescue Plan Coordinator and Senior Advisor to the President, joining us right now. And Gene, we talk a lot here about this report as being one thing. But there's two surveys in there. An establishment survey of employers that came in well above expectations, and a survey of households that came in well below expectations. The question isn't whether the labor market and the economy is good. It's why don't households think it's good?
Well, as you said, I look over this year as a whole. You have 247,000 as the average for 2024. I mean, that's an extremely strong year. You take out the president's last couple of years, that would be stronger than any jobs year in over 20 years. So this is strong. But you've seen in the jolts, you've seen some moderation. But I think we should all be happy to see the American labor market staying strong. And I think really, if you'd been a year ago and somebody said, we can bring the Fed's favorite inflation measure, PCE, down to 2.7, core PCE down to 2.8, and be averaging nearly 250,000 jobs a month, and still be, it was just barely under 4% at 3.96, but under 4% unemployment for 28 months in a row. That is, fairly Goldilocks, in terms of getting it, feeling quite right. And you saw wages at 0.4%,
yes,
which is going to be above inflation. So we are at a period now where the average worker is having wage gains above the rate of inflation. So I think on the whole, we should feel quite good about the resilience, really the extraordinary resilience of this recovery that, we believe was helped by the American Rescue Plan and other supports. And I think surprised a lot of the forecasters.
Do you think that resilience, is that going to continue? At least you see sort of the elements there that can keep this going.
Well, I think you do see, elements of moderation. So, for example, you saw job openings starting to return to more normal levels. You've seen some things in the economy that, are soft landing-ish, but there's still, a strong degree of resilience. You really can't think about 247,000 jobs even soft. It's kind of good landing place, but I think so far there's a lot of promise here. And again, I think resilience has been the key. We said when we were having that rocket growth in 2021 that the goal is going to be able to transition to employment and growth that was strong but more sustainable. I think this is really meeting that as well. And of course, it's always a mix, right? You see some of that moderation. You say that was pretty strong, but then you worry. Then somebody says, well, is that a sign things are going to moderate too much? When you see a jobs number like this, I think it's got to give a lot of people a lot of comfort that this recovery is still resilient, and that having so many people working, people starting to get real inflation wages, offers a lot of promise for the future.
So, Gina, there's more jobs in many areas, higher wages. How much is the acceleration of inflation a concern to this White House, particularly as we head deeper into campaign season?
Well, obviously this is an issue of great discussion people have. I think what a lot of people think is that, people are often frustrated by the price levels. So they look at something in the grocery store, and actually it's coming down, or inflation is very low. So something like eggs is a great example. I mean, you had deflation, but it's still higher than it was in 2020, 2019, or so people, so the inflation, I think, again, 2.8 for PCE inflation is not a particularly worrisome number itself. People are still frustrated because of the pandemic and prices being a little higher. Yes, you see that, but it's also very interesting that when you ask people how they're doing, strong majority say they're doing pretty good. So you have this world where people are kind of saying they're doing pretty well, but they still seem to be expressing, at least the pollsters, some worries, but their actions don't show that worry as much. You see consumer spending strong. You see amazing small business applications, which is the ultimate confidence in the economy to be starting a new business. So, this is not a simple gauge. I would say there's, a bit of resilient unhappiness with the pandemic and prices and the supply chain issues. Yeah. You see people feeling better about their own circumstance, and you see in their actions the spending, the starting of small new businesses, that people are expressing some confidence in this economy.
James, always to get your take here directly from the White House, Berlin White House, senior advisor to the president there. We'll be back in a moment right here on Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
Bloomberg, this is the deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Let's get a view from the sell side with our top calls. The big movers on the back of analyst recommendations, and we start off with Vail Resorts, having one of its worst days since the pandemic after the ski resort company slashed its EBITDA outlook. J.P. Morgan's Matthew Boss, not a fan of the move, downgrading his recommendation on the stock to underweight, citing key headwinds, including pushback by skiers after 3 years of price increases. Those shares down 11%. Skechers up next, an upgrade to buy over at Bank of America, which cites an improving wholesale environment for the footwear company, as well as second half management outlook that the analyst says could prove conservative. The analyst also sees promise in untapped markets overseas, in China and in Latin America. Those shares up 2%. And finally, let's take a look at Lyft. Impressing a slew of analysts after its investor day, Gordon Haskett raising its neutral rating to buy. As for all that skepticism surrounding management's financial targets, the analyst says that's simply creating a low-risk, high-reward buying opportunity. He also praises Lyft's price lock feature as a way to attract and retain users. Shares, though, down fractionally on the day, and those are some of our top calls. Now, we are happy to have the analyst behind that call with us now, Bobby Mullins, Director of Internet Equity Research over at Gordon Haskett Research Advisors. And Bobby, before we get to it, we actually had a chance to catch up with the Lyft CEO, David Risher, earlier today. Listen to what he had to say about how he would make good on its gross bookings forecast.
Customer obsession is what gets us there, right? I mean, we're a scale business. We're a scale business. We do 2 million rides a day today. We're going to get to $25 billion in bookings over the next couple of years. That just means doing more of what customers like, picking them up faster, pricing better, and then innovating, like with Women Plus Connect and some of the other things we've talked about before. It's really the basics, but you do them really well over and over again, and you can grow an incredibly big and profitable business.
And Bobby, that was, of course, the CEO over at Lyft. You had a chance to hear from him directly at that investor day here. You buying it? You think there is a plan? And more importantly, you think he can execute it?
I do. I don't think they would come up with some targets that they couldn't achieve. And, I'm still a little bit skeptical myself, just kind of like everyone else is. But I do think it does create a buying opportunity for the long term.
How much do favorable rulings regarding things like Prop 22 and other regulatory matters mean to this company right now, Bobby, and its share price?
I think it means a lot. The reason why is because if Prop 22 does get upheld in California, that creates a legal precedent for other states that may try to do something similar. So it actually makes the path forward a lot easier for not just Lyft, but all gig companies out there.
You used to be able to, I feel like, arbitrage Lyft and Uber, and now it seems like a Lyft driver is an Uber driver and vice versa. How do they sort of unconfuse that? Are all drivers on all platforms at this point?
I think so. We have the mindset that, if someone is on the Lyft platform, chances are they're on Uber and vice versa. And both companies seem to be aware of that. And it's up to the management teams to create the best possible driving experience to keep those drivers on their platform. And both companies have done a pretty good job of doing that.
When we talk about sort of what David sort of laid out too with the advertising strategy, I mean, there are a lot of components now swirling around Lyft that didn't really seem to exist, or at least they weren't promoted a lot publicly over the last couple of years. Is this going to be kind of the broadening out of the business that I think a lot of investors have looked for?
Yeah, we think so, but it's still early on, so it's kind of to be determined. But both companies seem to be executing pretty well on the driver supply side.
All right, Bobby, thank you so much for that. Price target now of $20, up from $17. That is Bobby Mullins over at Gordon Haskett Research.
Yeah.
And Romain, I don't know if you tend to use Lyft or if you use Lyft on City Bike or what you do.
Yeah. Well, I mean, I use all the ride apps here, and I don't know. I mean, I think the advertising strategy is interesting. The Women Connect strategy is also interesting. The idea that maybe they make people feel like their service is somehow safer than the others, and that's a way for them to steal market share. It's interesting because we always talk about Uber as having two sort of modes, if you will. They have the ride share, but they also do the delivery, food delivery, something that Lyft has avoided.
Exactly. Lyft is staying true to its roots, although it has moved into transportation, has moved into bicycles and things like that as well.
Now you're one of these. You ride those city bikes around the city? That's dangerous,
You know, at nighttime when no one can see me.
Nighttime.
In the very early
well, just
hours
wear
of the morning.
a helmet. You know, people drive crazy. And now that Hochul has gotten rid of our, congestion pricing, we're all, ooh.
Well, we're going to talk economy with Nathan Sheets in a few moments, Global Chief Economist at Citi. Stay with us on The Close on Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Wednesday, the Fed decides.
What data is important?
What would it take to reintroduce the rate cut conversation?
It's the labor market cracking that's going to allow the Fed to really enact some of its easing.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Inflation is still too high, and the path forward is uncertain.
They believe that policy is sufficiently restrictive.
The Fed can only deal with the data that it has.
Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Vonnie Quinn. And I do want to mention GameStop, Romaine, because it was one of the major stories of the last few days. In fact, up 47.5% yesterday, down almost 40% right now, having had many, many trading halts throughout the day. Keith Gill seemingly disappointing investors, but also GameStop itself coming out and maybe preempting some of what Keith Gill would have had to say by releasing earnings 3 market days earlier and announcing, a bigger share sale.
Yeah, it was kind of interesting that GameStop did that. You kind of wonder sort of what was going on, why they would move up their earnings report. I don't know. Did you actually watch the Keith Gill video today? Because it was bonkers. And I mean, like, at some point you're like, okay, dude, like, get to the point. What's the fundamental case? And he did eventually make the case here. But as you see here, it didn't really move the stock. Well, it did move the stock, but just in the wrong direction.
I was, perhaps like you, one of the almost 500,000 people waiting for it to start, just to see what was he going to say. And of course, it was rambly at the beginning. But then the basic fundamental point point was that he didn't have a new case.
Yeah.
He said we were on to part 2 of his original thesis, and I'm sure many, quote-unquote investors were anticipating maybe.
So that's one of the big movers here on the day in the equity market. I think some of the other big moves are in the Treasury space, Fani, and of course all that has to do with that big jobs report that we got this morning.
Yeah, so we've gone from absolutely the opposite of fundamentals to fundamentals, and that's what you can see in the Treasury space. As you say, back to the jobs report and what it means for the Fed's rate path. Earlier today, we talked with Acting Labour Secretary Julie Su. We asked her what the numbers actually say about the broader economy.
The payroll survey is the survey that tells us how many jobs have been created, what industries they've been created in. And again, the growth we're talking about is not just single industry, right? It has been for the entire time, but certainly this last month is no different, very, very broad base. We have historic job growth, low levels of unemployment. I think it is the very definition of a soft landing.
For more perspective, let's bring in Nathan Sheets, Global Chief Economist at Citi. So Nathan, before we get to the Fed and what it might have to do with the data that we saw today, where did we go wrong? How do we not see that these jobs were likely to be created following 3 days, basically, of employment data?
Yeah, great question. Great question. Well, first of all, it is notoriously difficult, and I can tell you this from experience. It's notoriously difficult to forecast these monthly NFP releases. They are very, very volatile. But I think underneath that, we were reminded yet again that this is a very resilient U.S. economy. And we have had some data that have pointed to a moderation in activity. And there was an argument, well, is that a harbinger of a sharper slowing? Or is that the soft landing that we've all been hoping for? And these data suggest, these labor market data this morning, suggest that there's still a fair amount of momentum in the economy, and certainly does strengthen the case of those arguing for the soft landing.
It certainly does, Nathan, but Mohamed El-Erian was making the point a little earlier on Bloomberg TV that perhaps the Fed is too late. And it's difficult to reconcile the idea that the Fed might be too late cutting rates with an economy this strong, right?
I understand that case. That's very much the economy has softened some. And once it starts to soften, it tends to soften more non-linearly. But I do think that this time is fundamentally different. We're coming out of the pandemic. We knew the economy was too hot. We were calling for a moderation, a cooling in activity. We needed a softer labor market. That was the Fed's objective. And, all in all, I think we're getting that moderation. And I think underneath it, there's still plenty of strength in demand. So I understand the concern that, well, maybe things are going to soften too much.
Yeah.
I just don't think we ought to take that as the base case at this stage.
I mean, is there even an argument to be made, Nathan, if you had a seat at the table there at the FOMC, is there even a case to be made at all for easing policy anytime soon?
I think it's a stretched one. I think the Fed at their meeting, they're going to look at where the economy is, and they're going to say we have time. And I think they're going to wait for more evidence that inflation is clearly on that 2% trajectory that they've been working toward and to which they desire. Now, as they wait, they will be vigilant. They'll pay careful attention to what's happening in the economy. And if some of these signs of softening do seem like, if they appear to take hold, then I think that the Fed will respond to that. But I don't think there's a strong case to cut at this meeting or really, as you said, anytime soon.
I want to ask you kind of a somewhat esoteric question, Nathan, and that's really about the reliability of this data. We had some news break a little bit earlier about how BLS is actually going to reduce the sample size on the household survey. Now, this is primarily because of budget cuts and not because of anything else, at least what we know publicly. But, there's been a lot of hay made out of the dueling surveys, the establishment survey, the household survey, how these two intertwine, and whether we truly are getting an accurate picture of what's going on in the labor market.
Clearly, there's a lot of noise in the labor market data. I think that's the reason you want to look at a whole range of indicators. But when I look at the claims data look pretty solid to me. The average hourly earnings number that was part of this report, I think, continues to point to some labor market tightness. As I said, there's some other measures, really more about the soft data that suggest some more marked cooling. But all in all, I think that this is a moderating but still solid labor market. Now, final bit that you alluded to is there was a wide gap between the establishment survey, the overall employment number, and what was embedded in the household survey. But I can tell you that the Fed, and I was at the Fed for many years, has historically taken a lot more signal from the establishment survey and sees that as being much more reliable, notwithstanding the fact that even that has some challenges.
Nathan, Citi now expecting a first rate cut in September and not July. That's a little bit of an outlier call in the sense that we are just 6 weeks to 2 months away from the election. A central bank would love to not even have the appearance of being political, right? And there will be a lot of people saying the rate cut cycle cannot possibly start before the election or that close to the election. Would that give you a pause at all in this Citi call?
Continuing to draw on my experience inside the Fed, I think the DNA of the Federal Reserve is to follow the data and seek to do the right thing at the right time. And if the data are suggesting that the economy is ready for cuts, and cuts are consistent with the Fed's dual mandate, I think that the Fed will not hesitate to cut, even in September in the heat of the presidential election. Now, as I say that, I think that has got to be the headline. But at your point, though, in quiet moments, when Jay Powell is sitting in his office and he thinks about pros and cons, if he can make a case a little bit earlier, a little bit later for the cut, and it's not right in the heat of battle, I think he'd be happy with that as well. So it's complicated.
All right, Nathan, going to have to leave it there. Always wonderful to talk to you. Have a great weekend. Nathan Sheets, Global Chief Economist at Citi. Stick with us. When we come back, we're going to talk about one of the big movers on the day and, well, one of the biggest IPOs of the year. This is Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The names that move markets are on Bloomberg.
It is President Biden's top priority to bring down the cost of living.
The United States' ability to spend without constraint is not unlimited.
We're in a very unusual time, and so the adjustments are taking place, and it's running through the economy.
We do need more innovation, more investment, single market and capital market union, and a
a relevant trade policy.
Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
Bitcoin ETFs rubbing elbows with the big dogs.
This frenzy has engulfed the entire world.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
All right, there's a new kid on the block, and well, it started trading today. It's time for our stock of the hour, and we're taking a look at shares of Waystar, the fourth biggest IPO of the year and largest by a U.S.-based company. The shares pricing at $21.50 last night. They did open below that, trading below that now, down about 3% here on the day. It's a healthcare payment software maker, and the CEO of that company joins us right now. Great to have you here on the program. Let's talk a little bit. And Matt Hawkins, I'm getting ahead of myself here.
Thank you,
Matt, great to have you here on the program.
You. Delighted to be here.
First of all, congratulations. I mean, it's always a feat to bring anything to market, particularly in this environment where it's been a lot harder for IPOs to sort of get traction here. Why did you feel it was appropriate for you to come to market now?
We feel like we're building a durable, high growth, highly visible business. And it's a testament to the work that we do with over 1 million providers who use our software across every setting of care. Mm-hmm. We feel like coming to market now gives us more awareness of who we are and visibility to our company, the value that we bring to providers. Mm-hmm. Gives us a sense of credibility as we work to establish trust with the clients with whom we serve. And then certainly it's helped us improve our capital structure. We were able to delever the business through the proceeds of the IPO. Our investors are in the business and along the journey with us, believe in what we're building. We were fortunate to add a number of additional investors through this process, so we're thrilled.
Yeah, you're going to have a lot more investors here. I mean, it's a lot different being a public company. You have a lot more people you have to answer to, and that gets to be a little bit of a grind versus being a public company. Talk to me about the growth strategy. This is a company that had, at least last year, roughly about $800 million in sales. What is the growth plan, the growth story that you're pitching to investors?
Healthcare is such an important category for all of us. The pains that we're helping provider organizations to resolve as they use our cloud-based software platform that, by the way, has artificial intelligence throughout our platform to automate work, to prioritize and organize work, and to create operating efficiency. We tell that message to clients and potential clients, and we show them a real way to create lasting return on investment. And we're fortunate we have referenceable clients. We serve over 1 million providers across every setting of care, and we're market leaders in client satisfaction. So all those things contribute to strong win rates, long relationships with clients, and that becomes an important part of our growth story.
EQT is still going to be your largest shareholder, about a 29% stake. Also Canada Pension Plan, Investment Board, Bain Capital, Francisco Partners. How much of a say are they going to have on day-to-day operations, and how much are they going to want to see a return? We have fabulous investors. They are on our board of directors, but from the very outset, EQT, who I'm very appreciative of partnering with, they have asked us to behave as though we're a public company. So we've had a number of independent board members join our board prior to this event, and we govern ourselves accordingly. So while they have a say, they're wonderful thought partners, and they trust us to lead and guide the business. All right, well, Matt, once again, congratulations on pulling this off in a week where there was a lot of noise, a lot of distractions, and some of the other big IPOs didn't manage to do it this week. So that is Matt Hawkins, CEO of now public Waystar.
Thank you so much.
Coming up, Jay Woods, Chief Global Strategist at Freedom Capital Markets, will speak these markets, particularly on a day post non-farm payrolls, when the market is now looking ahead towards next week's inflation data and the Federal Reserve meeting once again. This is The Close on Bloomberg.
is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
The top names at the Fed are on Bloomberg.
The way I look at it is, we have a restrictive monetary policy in place. It has shown up in terms of moderating the labor markets. They're becoming better balanced.
I do think that our new steady state is likely to be higher than what people have known over the last decade. I think that it will take quite a while for us to get all the way to 2%, but I do think we'll get there.
Nobody covers the Fed like Bloomberg. Context changes everything.
So we're looking now to the market on close imbalance. Last time this week, S&P 500 2.4 billion to the sell side. NASDAQ 100 859 million to the sell side. Dow 30 750 million to the sell side. And Mag 7 all sells at 610 million to the sell side.
This is the countdown to the close. Romaine Bostick alongside Vonnie Quinn here on the final trading day of the week, Vonnie, and it is not looking good here. Stock's been on the back foot for a good portion of it, moving deeper into the red now that those closing bells are just 10 minutes away.
For sure, having hit another record this week, we should mention for the S&P 500, but we are backing off that ever so slightly. We had been flirting with the unchanged mark all day, but now we're at 53.49. No huge catalysts here today, except for, of course, that jobs report, which did put a bit of a spanner in the works, particularly for the bond market. But I do also want to point out the small cap Russell 2000 index down more than 1%. A very different reaction for small cap investors than for large and mega cap investors, potentially looking at other things coming out of this jobs data. But the 2-year yield, look at it, 4.88. We're not far off that 5% mark. Once again, we've hit that maybe 4 times in the last year. Will we hit it again? Well, we'll have to wait for next week to see. But certainly rates aren't coming down as fast as we might have anticipated yesterday. The 10-year yield back at 4.4296.
Yeah, one of the biggest moves that we've seen in those benchmark yields in about 2 months here. As we continue to count you down to those closing bells with just about 9 minutes to go, let's bring Jay Woods into the conversation. Chief Global Strategist at Freedom Capital Markets, joining us here in Studio One. And Jay, I'm going to give you some optionality here. We can talk about that boring jobs report. We can talk about the boring Treasury market. We can talk about all the boring moves out there right now. Or we can talk about Roaring Kitty, GameStop, and this, I don't know, train wreck of a live stream that that he had just a couple hours ago?
That's far from boring.
Yeah, okay.
And all-time new highs are not boring either.
Yeah.
And amazingly, we are making those. So we're seeing a lot of mixed signals in this market. Let's hit on Roaring Kitty right out of the gates because sadly I fell into that trap and I had to watch that train wreck of I don't even know what to call what we watched. But there was a lot of hype around this. The fact that GameStop released their earnings today and not like they were supposed to last week, they took advantage of the move. He is still in love with GameStop. He was very careful in his wording because the one thing we're watching for is, manipulation. Is there anything illegal? He's done nothing illegal. There's nothing wrong. He's got a big following. We see 13F filings, and Warren Buffett says he owns Chubb, and boom, Chubb goes up 15%. Now, he's no Warren Buffett. Let's not make the comparison there. But this was the show, and unfortunately, this is what people were talking about today, not that jobs number. And let's go boring then.
Well, let's go boring because, I mean, we kind of bring it up because it kind of gets to the heart, though, of where market sentiment is right now. And Bonnie points out, look, we're down day, but like I said, we were at a record high yesterday on the S&P and NASDAQ. So sentiment is still overall still there. Maybe not for GameStop, but certainly for the broader market. Yeah,
but it's not broad, as Vonnie said. The Russell is down again. That 10-year yield, 4.35%. As a technician, as someone that follows price action very closely, we were pretty excited to see it break 4.35, and the 200-day moving average. Well, it got back up there. It got back up there quickly. It's not alarmingly high. It wasn't a spike. CPI. Watch the CPI next week. Same day as the Fed meeting and press conference. It's going to be a doozy. But the CPI of any other economic data point, that causes more volatility. The VIX is down today. We had a little sell-off, but it's bifurcation. The haves are rallying. The NVIDIAs of the world, the mega caps are rallying. And then you have to be selective as to what rallies within which sector. I look at the consumer staples. Talk about boring. It's a sector that is about to make all-time closing highs. On a monthly basis, I know we're very early in June, but we are right now at all-time monthly highs if it was to close right now. This is very positive. Then you look at the top 5 stocks in that sector. The Costco's, the Walmarts, the Procter & Gamble's, Coca-Cola, Philip Morris, all 5 new highs this week, I think today. There's strength there, and that's boring, but that's where people are rotating to.
Just one more question on GameStop before we leave it, Jay. I mean, at what, 28.49, we haven't even erased yesterday's gain, even though the stock is down 40%. It rose 47% yesterday. Are there any fundamentals to support that kind of a stock price, given that we also saw more dilution today, 75 million shares? We saw earnings, which weren't earnings, they were a loss. And Keith Gill doesn't have any new information that he's giving away yet. He's just saying he believes in Ryan Cohen still. Same thesis.
Yeah, that's the story. There are no fundamentals. Yes, they did have a capital raise, so that could help them over the long term. But their earnings were out. They missed. They were down 29% year over year on sales. That's not what you want to see out of a growth stock. So fundamentally, no, it will eventually calm down, get back to the fundamentals. This has been a nice sideshow. It's been very fascinating to watch. It's the sequel to the movie, basically, is what happened. And, how long this will last? Probably not much longer.
So anyone who did have the cash to put into GameStop, assuming they haven't lost it, where should they put it now instead?
Well, I'm always the long-term investor, and you put money into the S&P 500, despise the Qs, and then, buy companies I would still put money into NVIDIA. I think that's where the biggest growth is. The biggest customers for NVIDIA are the mega caps. Yes, it's a little overdone, and the RSI is getting exceedingly high. But I think on pullbacks after the split, digests, it may go sideways for a little while, but a long-term story, the mega caps are still where you want to be. Technology is where you want to be. And short-term, if you're a little nervous, staples are looking good too.
I am curious, though, on NVIDIA and that stock split. I know technically stock splits aren't supposed to matter, but do you think it could matter just in terms of generating more interest, generating more of that retail trade? Could that provide some more momentum?
I'll tell you who it mattered to. My father, who owned 10 shares, and now he's going to have 100. When you own something like that, you feel like you win. But when you look historically at some of the mega caps, Tesla and Apple back in 2021, they both had sizable stock splits. Tesla ran almost 30% when they announced the split to when it actually split. So people want to get in. There's this sense that I have more. Now, we both know that you have the same amount. The market value is identical. But there is this sense of pride, sense of winning, that you can brag that I had the stock that split. It's psychological. It's behavioral. It is not fundamental, that's for sure.
We have had a huge run up, though, and there is skittishness here. Anytime there's any kind of a headline that's maybe negative, like, for example, the regulation headline yesterday, we're seeing a drop in the stock by 3.5%, and there was a 10% drop, remember, maybe a couple of weeks ago. So, is there a word of caution here on NVIDIA that we might be fully priced for where the company is at right now?
Well, NVIDIA is always going to be volatile, and we had a 20% correction last year, went sideways for 5-6 months. It's going to take you on these roller coaster rides. Taiwan, China, that story, if that gets any bigger, that will be a major headwind for them over the near term. But right now, when it comes to competition, they were on the stage with AMD. Intel announces another chip, and guess what goes up? NVIDIA goes up. So right now they're eating their competition's lunch and they're enjoying it. And the growth trajectory, they already talked about the 2026 chip. They haven't introduced the 2025 Blackwell. They're talking about Rubin, I believe is the name. The growth is there. The user base is strong. The demand is unbelievable. I'm in the Dan Ives camp that this is still early innings in the AI play, and NVIDIA is the way to go.
Yeah, absolutely. And I was just taking a look at the weekly gain that we're seeing in NVIDIA right now, up for 7 straight weeks. On NVIDIA, and believe it or not, that's not even the longest win streak this year for NVIDIA. Jay Woods over at Freedom Capital Markets. Stick with us. We are counting you down to the closing bell. Stick with us. We're about to take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Bonnie Quinn. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast. We're joined right now by Tim Stenovic and Emily Grafeo as we welcome our audiences across our Bloomberg platforms. That includes television, radio, and yes, Tim Stenovic, those folks still watching us on YouTube.
We're everywhere. You can't get away from us, which is fine on a day like today, which is a Jobs Friday. I got to tell you that with the data that we saw come this morning at 8:30 Wall Street time, I was expecting a bigger reaction with the equity market, given that we're kind of seeing this reset when we think the Fed is going to cut rates. Just not seeing that with equities today.
It's all about the bond
market.
Nothing
happening.
It's all about bonds.
It is all about the bond market.
That's what Bloomberg's Michael McKenzie told us earlier today. And you look at that market, we have the 2-year up almost 16 basis points, a big sell-off there in the market after that hot labor market data.
You have to wonder if this whole idiom of sell in May, go away just doesn't work this year, right? We're at record highs, and even if we're seeing a slight sell-off, I mean, I'm not sure you could even call it a sell-off. It really is in individual names and individual stories.
Yeah, and we talk about this idea coming off those record highs from earlier this week here and setting up for what is now going to be a weekly gain for both the S&P and the NASDAQ. The Dow Jones Industrial Average also clinging to a weekly gain. But the Russell 2000, those small caps, the mid caps, the transports, all lagging this week once again.
Yeah, I mean, I think the question that I have is how this data that we got today when it comes to payrolls, Romaine, changes what the Fed at least does in its dot plot next week, which we'll get on Wednesday. It's kind of the next big catalyst.
Yeah, those economic projections are going to be huge because they are going to have to make some shifts because so much has changed in the last few weeks since the last one we got 2 meetings ago. Let's walk you through the numbers here on this Friday afternoon. The bells ring, people clap, and the markets are down. The Dow Jones Industrial Average